All right, fools, welcome back to another hour of Fool24. I am your co-host for this next hour, and I'm happy to be joined by Jose again. Jose, how's it going?
Pretty good, Rachel. Pretty excited for today's episode. We got an interesting week ahead of us.
We do indeed. We do indeed. So this is another Ask Us Anything themed hour. I know there's a lot of questions already in the queue from the earlier shows today, as well as previous days. If there's any of those that either Jose or myself can get to in this next hour, we will do our best. But in the meantime, if you have any questions that you've just been itching to ask either Jose or myself, go ahead and get those in the queue in the Slido. The event code for that is Fool24. Well, Jose, it was an interesting week in the markets. We've been talking a lot on recent shows late yesterday as well as today, looking back at the market this last week. It was an up and down week, although Friday was a stronger close for stocks than we had seen in recent days. But it's almost the beginning of a new week, which is hard to believe. Time flies. I'm wondering, Jose, right now, as we're looking towards the new week, is there anything in particular that you're following? Earnings season is winding down. There's really maybe just a couple stragglers that are getting in their reports in the coming days. What are you paying the closest attention to as we head into the new week?
Yeah, so like you mentioned, Rachel, we kind of have the ending of earnings season, but we are seeing kind of a pickup of a lot of investor events. And usually a few weeks after earnings, a lot of these companies go into big banks or big analysts kind of have these conference events with a huge amount of companies. And it's been pretty busy the past few weeks with the semiconductor industry and the tech industry. And this week is going to be pretty much the same. On Tuesday, Rachel, we do have, I think, the most important one is going to be NVIDIA's GTC keynote, where they're going to showcase all their new products. But another one, Rachel, that's going to happen on Tuesday that I'm going to be curious about is Adobe. Adobe will have their Summit 2025. And this is where Adobe kind of talks a lot about what they're working on with their creative side. And earnings were last week, I believe, and the stock price didn't do that well.
Hmm.
And management didn't share maybe too much details about the AI market or what they're doing more into the AI space. So I'm guessing the reason they didn't want to share too much is because whatever they have in store, we will most likely get during this Adobe Summit later this week on Tuesday. So curious for those two on Tuesday. Like I said, NVIDIA, very important for just one of my main positions in my portfolio, and Adobe after kind of that earnings downturn, we kind of saw. I want to see a little bit more of what they're doing. Now, I also want to mention Thursday. Thursday, we do have Micron Technology reporting earnings, and this one is a little bit later in the game that kind of reports their calendar years a little bit off sometimes compared to the quarter. So I think they give us like an extra month of visibility of how the AI space and how the semiconductor industry is going. And luckily, Rachel, Micron, they deal with memory, and memory goes into everything. It goes into your phone, it goes into your cars, into the data centers, into AI chips. So they're like that one company that can tell us exactly how every different industry is kind of moving. So I am pretty excited for Micron after the market. Then another one that I might be kind of curious for Thursday is a semiconductor company called Monolithic Power Systems. Very boring company, but in the past few quarters, this stock has dropped about 30% because they did lose kind of a customer of NVIDIA. I want to hear if during this Investor Day presentation, they kind of maybe remove some of the fears that investors might be having. So a lot of different stuff in the semiconductor industry, some earnings, some keynotes. And again, even though earnings are out, we do have a lot of events happening next week.
Yeah, absolutely. Yeah, there's a few things I'm watching, and a couple of those you already mentioned, which was great. One of the biggest things that I think investors and consumers are following is going to be the results of the Federal Reserve's upcoming meeting, which will conclude this next week. But there's also going to be earnings reports from some companies, like you mentioned, including Micron. FedEx is actually another one that reports this next week, and consumer staples business General Mills is another earnings straggler that we'll be seeing results for this week. But I think broadly speaking, whatever news that we do get from the Fed is going to be one of of the more significant impacts that we see in the markets. Although obviously the market, we've talked about this a lot, has been pricing in already the expected results from the Fed, but we could see some additional volatility there. One thing on Monday, we're going to be getting some fresh data about the consumer landscape with the retail sales report. We've obviously been seeing some mixed numbers that have come out recently about the state of consumer spending. One report I talked about yesterday was the well-known University of Michigan survey of consumer survey, and that was for the month of March, posting a reading of 57.9, which was a 10.5% decline from February, and also below the Dow Jones consensus estimate for 63.2. So this new retail report that comes out Monday should give us a lot of insight into the state of the U.S. consumer right now. And then, as you mentioned, you've got NVIDIA's annual conference starting on Tuesday. Then following that, the Fed is going to be meeting on Wednesday. So we should be getting a read of inflation there. Obviously, we've been seeing some economic data that's already come out that seems promising, but there's going to be a lot to watch there. I think another company that's a couple other companies worth noting, Nike's reporting on Thursday, and Darden, which is the parent company of a whole range of restaurants, including Olive Garden, is actually going to be reporting on Thursday as well. So a few different things to watch there. And then on Friday, Carnival Cruises is also going to be reporting. So some companies across a few different industries that I think are, broadly speaking, perhaps not going to be the biggest market movers, but could give some insight into the state of the U.S. consumer. Now, it's worth noting in regards to that Federal Reserve meeting that is much anticipated, it's broadly expected that the Fed is going to hold interest rates steady at the end of their two-day meeting, which concludes on March 19th. We've obviously seen a dynamic where high interest rates have put pressure on households. There's been some easing of borrowing costs that could, provide some relief for consumers, but they are expected to hold interest rates steady, even though there has been some encouraging information about the state of inflation. So maybe more to watch this week than one would think at first glance. There's certainly a lot going on in the markets as well to keep us talking. There's a few questions that have already come in, and there's maybe one or two I wanted to hit. And then if you want to look through the queue, Jose, if there's something you want to grab in there. But LY Winners Win was saying, I've never heard anyone spell out the acronym M&A. What is it? So when we say M&A, we're referring to mergers and acquisitions, which is a common term in business and finance. We haven't seen as many mergers and acquisitions the last few years, following the significant uptick in that area that we saw in 2021. But essentially, when two or more companies combine to form a single new entity and essentially dissolves those original companies, that's a merger. Acquisition is when one company purchases another company, typically absorbing the acquired company into the larger entity. So M&A encompasses both of these types of transactions, mergers and acquisitions, which, while talked about in correlation to one another, are two distinct and separate types of transactions. It's basically a broad area of corporate activity that's focused on consolidating businesses and achieving specific end goals. And these are lengthy processes as well. Often for any of the companies that we own or follow, it's very likely that you're going to see news of M&A activity around those businesses. The healthcare space, for example, is an area that I follow very closely. Quite a bit of M&A activity within the pharmaceutical space. Broadly speaking, it's not uncommon for some of these big pharma players to eat up some of these smaller businesses. I've talked a lot about the recent streak of acquisitions that Pfizer made in the last several years, for example, from the success of its COVID-19 products. It acquired something like 6 to 8 new companies over the span of a couple years, one of which was a $43 billion acquisition of an oncology business. So that's what that refers to. And it's certainly something that we haven't seen as much of in different industries recently, just given the environment and somewhat dampened appetite concerning M&A activity. But there is definitely, there are stories to follow there. So that's what we are referring to when we use that term. There was a question actually kind of related to that from Ed. Maybe you also have a prediction for this. I don't know as well. Ed was asking, what company do you think might get bought out or merged? It's hard to say. I was talking earlier today about a company like Teladoc that has been just probably one of the biggest losers in my portfolio to date. I have a very small position in that company now. And as its valuation has come down significantly in recent years, I can't help but wonder if perhaps it could be, a target of acquisitive efforts to get wrapped into a much bigger and more successful and hopefully more profitable enterprise. One story that kind of caught my eye this last week that sort of goes along with this theme is Spirit Airlines. For anyone that follows the space, knows that they've been under bankruptcy protection. They actually just exited bankruptcy, which they achieved their target of emerging from bankruptcy protection in the first quarter. This is a low-cost airline. They were, delisted. It is not clear when shares will be listed again. And also just to clarify, this is not a stock I would be buying, even if they were to be relisted anytime soon. I think they have quite a lot to prove from a financial standpoint. But this is a business that, one could see perhaps being the target of an acquisitive effort. They had rejected multiple recent merger attempts by a fellow budget carrier, Frontier Airlines. But management has also said and stated on Thursday, when the news came out that they were exiting bankruptcy protection, that nothing is off the table, that the fifth largest airline in the US as a low-cost carrier makes sense. The airline is focusing on stabilizing itself after bankruptcy. But if management's saying that nothing is off the table, one can't help but wonder if maybe they are open to some type of an acquisition discussion in a way that they were not before. So that's another company that I'm sort of watching with the news. Certainly would not be an investor in if they were to become relisted, but I could see that being a valuable target for acquisition for one of these bigger airline companies.
Yeah, Rachel. I mean, in a few companies that maybe not companies, but in the semiconductor industry, Rachel, right now I am kind of seeing this nice bullish trend in semiconductor equipment. And there are a lot of semiconductor equipment companies that are very small, below kind of like that $10 billion mark. And then you have kind of like a huge gap of like the mega giants that are closer to $100 billion in market cap. I believe in this market, we are going to see some form of maybe those big players absorbing some of those smaller players. Because all of them are in different countries, I think it's a little trickier with these acquisitions. But if I was to guess, a market that could kind of see an increase in merger or acquisition noise, I think would be that industry. The other one that I started to think, Rachel, is we saw Microsoft a few years ago acquired Activision to become kind of like this big gaming company. I'm curious if some of the other big tech giants would want to absorb some of these other gaming companies. I mean, Activision was, I think, over 60 to 80 billion. I forget the actual number of the acquisition. And I'm looking at the other kind of big players here in the gaming industry. You have Electronic Arts with about $36 billion market cap. You have Take-Two Interactive with about $36 billion market cap. I would be curious if, because right now we're getting into this world where games, the IP that you have in games can also translate into TV shows, into books, and into other types of entertainment. So whoever has kind of maybe like a streaming platform, Amazon with their Amazon Prime, you have Google with their YouTube platform, you have Netflix. I wonder if one of these big tech giants would want to follow suit to Microsoft and maybe acquire one of these big gaming companies to, one, increase their creativity, and a few of those players also do hit kind of the gaming field already. So Microsoft did it. I wouldn't be surprised if some of the other big tech players want to acquire maybe one of those big gaming companies as well.
All right, let's see. I don't know if there was a question you wanted to hit in the meantime. I'm still scrolling.
Yep. I can take one. So about a day ago, Sadaf asked Jose, do you follow any Chinese semiconductor companies? So I would say no. And there's, in the semiconductor industry, you can kind of break them down into various ways, but the two quick, easy way to break them down is super advanced semiconductor solutions and kind of super mature semiconductor solutions. So I wouldn't invest much in advanced semiconductor solutions from China because of the US tensions happening right now. And that always happens. They get some form of restrictions in what products they can get, what kind of equipment. So for that reason, I don't believe they are competitive in the global space because of those export restrictions for how they can manufacture, the type of technology they get over there. So right off the bat, I'd like to invest on leaders, and that kind of takes them off from the advanced semiconductor solutions. Then you also kind of have kind of like the more mature semiconductor solutions. These are kind of like your analog devices, your chips that are a lot bigger. I don't like to usually invest in those industries because those industries are a lot more competitive. And you're kind of fighting more for margins, and you're really kind of really stuck and at the mercy of how that industry is moving. If it's a highly cyclical, it typically are highly cyclical businesses because one, you have a lot of competition. So if there's a massive over inventory, all these players try to fight for better pricing. There's massive pricing wars that causes margins to drop dramatically. So because the advanced space, they're not able to compete, and because the mature place, they are a little bit too competitive, and then just added the risk of being Chinese players. So any form of export restrictions and tensions can even add more volatility there. I tend to not invest in Chinese semiconductor companies. I feel the semiconductor industry has enough risk already with just everything that goes on, and you need to be a leader and continue to innovate. That adding more risk, I just don't think my heart can take it.
Thanks for that, Jose. There was actually a question that came in 23 hours ago from Phil. What are the mechanics of implementing tariffs? Who pays what when? I actually thought this would be interesting to talk about a little bit, and it's a good question because I think that there's a lot of confusion around that. And we've been talking a lot about recently introduced tariffs in the past couple of weeks. There's obviously been a lot of changes and exemptions that have been announced for certain tariffs. So it is still very early to be able to determine how that would impact different companies that we own and talk about. So many companies, source different components for the products that they sell in a variety of ways. Many have exposure to countries like China. Many have a much lessened area of exposure there. So we talk a lot about what the potential impact can be, and I think that's something that will shake out over time. But I do think it's helpful to understand how these work and what it actually looks like. So tariffs are taxes on imported goods. And these are implemented by governments for a variety of reasons. They can be implemented, for example, to protect domestic industries and generate revenue. The mechanics of it involve the classification, assessment, and collection by customs agencies. So we know that tariffs aim to increase the price of imported goods, which can make them less competitive with domestically produced goods and can encourage consumers to buy local products. And again, we're not here to comment on the politics of tariffs. That is far out of our wheelhouse here on that show, but it is important to understand the mechanics of them as they relate to the companies that we own. So there's a couple different types of tariffs. There's something known as specific tariffs, which is a fixed fee per unit of the imported good. So for example, a $2,000 tariff on a car. That's a specific tariff. Then there's a different category of tariffs called ad valorem tariffs. And essentially, it's a percentage of the value of the imported good. So you can have a fixed fee type of tariff, or you can have a percentage on the value of the imported good, like a 10% tariff on a vehicle's value, which we've obviously been seeing a lot of these types of tariffs announced in different days. When goods enter a country, they are into the US specifically, they are classified according to a specific tariff schedule. And the importer of those goods, so for example, a large automobile company, they self-classify and they declare the value or the quantity of those goods. Then Customs and Border Protection reviews that paperwork. They perform audits. They assess whether there's any applicable tariffs or penalties due, along with administrative fees. And the CBP collects the tariffs from importers, which again could be a large manufacturer, it could be some large company. They collect the tariff from the importer at the port of entry, and then they deposit that revenue into the general fund of the United States. That's the mechanics of how tariffs are calculated and paid. Now, who pays that? First, it's the importer. The legal obligation to pay tariffs rests with the importer of the goods. So, for example, a large automobile company that is importing a very specific part that is key for them to build, automobiles. This is just a very loose example. But ultimately, the importer, the company, pays those tariffs. However, what is commonly the case is that the importer, while they will initially pay the cost of those tariffs because that is their legal obligation under the law, they will pass that cost down to the end consumer. So the ultimate impact of tariffs is often passed down to consumers through higher prices, as importers tend to raise prices to cover the increased cost of doing business. So tariffs can sometimes protect domestic industries from foreign competition by increasing the cost of imported goods. And ultimately, tariffs also benefit the government because they generate revenue for the government. But then there's these drawbacks we've discussed. They can lead to higher prices for consumers. They can lead to higher prices for businesses. This can reduce purchasing power. And this can also feed into additional difficulties during a struggling economic environment. And then, of course, another major disadvantage that we have also seen occur in recent days that can be a response is other countries might retaliate by imposing tariffs on a country's exports, which can lead to trade disputes and other economic disruption. But that is essentially the mechanics of tariffs. The importer, which is the company or individual bringing goods into the country, is who ultimately pays them first, but then that cost is traditionally passed down to the consumer. Tariffs in the US are collected by Customs and Border Protection, as noted, and there are a few different types of tariffs assessed. But it's interesting to talk about this because it's in the news so much. It's something that I think a lot of investors are considering with regards to the companies that we own. For some of the businesses we own, it can be very difficult to understand how exactly those tariffs are going to impact those stocks. For me personally, when I'm looking at companies that I follow and or own, depending on what the industry is, the product or service that company provides. A lot of times in these companies' financial reports, specifically their annual reports, their 10Qs, they will go into a lot of detail about their supply chain and how they source different aspects of their products. And that can be a really helpful section to read within these reports to understand the exposure of a company that you own to specific countries or regions. That's important, I think, broadly speaking, when performing analysis of a company, but I think it can also be really useful in the specific context when we're thinking of the impact of tariffs.
Thank you, Rachel. I have a question I can take here from Hegni 3 days ago. I would like to understand the differences between Palantir, ticker PLTR, CRM, which is Salesforce, and ServiceNow. Are these competitors or are companies more likely to use more than one? I would say these are not competitive. So Palantir, Salesforce, ServiceNow do operate in kind of distinct niches in the software space, and enterprises will most likely use more than one. I think all three actually can be used by the same company. So Palantir, for those that don't know, the top level is it kind of specializes in data analytics. Kind of they talk about it, AI as a platform, or kind of like the engine for AI to be used to make complex decisions. So some of their big players there are Foundry, which is kind of the enterprise data integration. Then they have Gotham, which is more specialized for kind of the defense and government analytics. Then they have AIP, which is their artificial intelligence platform, which is kind of like a driven workflow for AI-driven workflow automation system. So that's Palantir. Palantir is kind of like that data analytics, that AI platform. Then you have Salesforce, ticker CRM. And this one really focuses on exactly what its ticker stands for, customer relations management. So kind of the use cases for this is sales team coordination, understanding data from customer retention, understanding data between target marketing. So it really kind of deals with that relations between the customer and the user. to understand where they're purchasing, how often they're purchasing, whatever type of data you can get with your customer, Salesforce helps you grab it. How they're doing with, let's say, if they have a bad experience, how do you improve that experience? Did they have to email you like 5 different times before getting the right results? Was your service team able to fix the issue in the first try, the second try? So a lot of this data can kind of come from Salesforce. Then ServiceNow, they do have a lot of different solutions, but on the top level, they kind of focus more on IT management and workflow automation. So use cases would be things like IT ticket resolutions, enterprise service management, and HR workflows. So overall, a perfect example would be a service company would use all three. So they would use Salesforce to kind of grab that data, to track customers' purchases, to track how quickly the shipment got to there, how satisfied the customer was. Then you have Palantir to be able to maybe analyze some of the supply chain bottlenecks using their AIP platform. And then you have ServiceNow, which can kind of create an automated inventory restocking workflow. So you can see how maybe a company that deals in the e-commerce space can use all three pretty easily. The great thing is all three are kind of seeing a boost with AI, where eventually if you kind of have an AI agent, which hopefully we get to in the future, you will have kind of like an AI agent from Salesforce be able to kind of talk directly to a Palantir agent, where they will be able to kind of share the data, and then that data will go to ServiceNow, where ServiceNow's AI agent will be able to do everything automatically. So I think even in the world with AI, all three are going to be working really well with each other. So when usually we think about software companies, we always think they're kind of competitive. And again, all these companies probably might have like a competitive product that they kind of overlap, but overall on their top level niche, they are completely different players, and they can definitely one customer can actually be using all three without really having to cut any if prices get too heavy, or if they have some pressure with cost.
There was, I'm sorry, did you have more to add to that, Jose?
No, I think that's all I have.
Okay. There was a question I wanted to hit from Ed, actually. Seems like a tough retail environment. What do you think of Home Depot at today's prices? So let's take a second and look at this. Home Depot has come down, I think, double digits over the last year in terms of the stock's current valuation, trading at a price to earnings ratio of about 24. The stock itself is down about 10% year to date, so not so far as of a fall as some of the other retail businesses that we have seen. And its dividend currently yields about 2.6%, which is a bit higher than the average for a typical S&P 500 dividend stock, which is usually around 1.3% right now. Home Depot has been facing a difficult environment in the last few years, but not because of really any fundamental issues with the business. They are highly reliant on the growth of areas like the housing market, right? So they sell home improvement products, construction materials. They sell, do-it-yourself type products to customers as well as professionals like contractors, plumbers, and electricians. And then they sell professional grade tools and supplies to contractors and builders. They also offer installation services, home maintenance, and professional service programs, where customers select and purchase material for a project, and Home Depot provides or arranges for professional installation. So they are highly reliant on a couple different things. One being the health of the home improvement market, the housing market, obviously, and the trajectory of new construction is something that would also feed into their business because, as mentioned, a huge part of their customer base is contractors, plumbers, electricians. In an environment where the housing market has slowed, where home improvement projects have slowed significantly in the last few years, no doubt partly as a function of a difficult macro environment where that is very much a discretionary expenditure, and a lot of households are more in a wait and see mode with those types of expenditures. This is something that has impacted Home Depot's business. The housing market has been in a sales slump. We've got mortgage rates that have been rising from pandemic era lows. It's made it much harder for consumers to finance larger projects. And because also higher interest rates have increased the cost of borrowing money, that's also led to a decrease in consumer spending on home improvement projects. Consumers have broadly been shifting their spending towards experiences over things. So travel is an area where we've seen that to still be the case. And of course, there's also been an overall curtailment of discretionary expenditures. There's been also the reality that this follows a period of kind of extreme pull forward during the pandemic, where there was this surge in demand for home improvement projects. People were spending so much more time than normal at home, and so if anything, it accelerated demand in a that would have probably been realized over a longer time frame into a much shorter period of time. And economic uncertainty plays a big role there. Now, in terms of how the actual business is doing, I still actually like this business. I don't invest super heavily in retail. This isn't one I currently own, but it's one that I follow and report on a lot, as I do a lot of companies here at the Fool. And to kind of give an idea of how the business is doing, their fiscal 2024 sales were about 160 billion. That was a 4.5% year over year increase. And that was despite the fact that comparable sales actually decreased slightly. Net earnings for the 12-month period were 14.8 billion compared to 15.1 billion a year ago. So a slight deceleration, but still profitable, roughly flat compared to 1 year ago. Now, the CEO, president, and chair of Home Depot, Ted Decker, said at the time that their results exceeded their expectations. They said they saw greater engagement in home improvement spend, even though there's ongoing pressure on large remodeling projects, which I alluded to earlier. He said, throughout the year, we remained steadfast in our investments across our strategic initiatives to position ourselves for continued success, despite uncertain macro conditions and a higher interest rate environment that impacted home improvement demand. Their biggest struggle right now is just an absolute decline in home improvement demand for all the reasons I mentioned: worries about the economy, the pace of interest rates, the cost of inflation, and the fact that consumers are just being much more cautious with where they put their money to work right now. But the underlying business, in my view, still looks solid. They still continue to increase their dividend. It's worth noting that this next quarter is the 152nd consecutive quarter that the company has paid a cash dividend, which pays out actually at the end of March. They increased their dividend by about 2.2% most recently to $2.30 a share. Now, looking ahead for fiscal 2025, because they did actually issue guidance for the full fiscal year, management is foreseeing total sales growth of about 2.8%. They also think that they're going to achieve comparable sales growth of around 1%. They also hope to open about 13 new stores in the year. So this is a situation where I think this is probably not a company that is going to see a massive scale up of growth in the next couple of years. I think that the environment they're operating in my opinion, is going to remain a highly dynamic one for the foreseeable future. But I do think the business thesis is still there. I do think that they have a robust balance sheet. They're still profitable and consistently so. They have a nice amount of cash on hand, and they continue to, I think, demonstrate their commitment to their dividend. It is worth noting that even though comparable sales growth has slowed, right? So sales in fiscal 2024, as I noted, grew 4.5% year over year. If you go back to pre-pandemic days, for example, in fiscal 2019, Home Depot's comparable sales actually increased 3.5%. So that was a slightly slower pace than now. So in many ways, they have reverted a bit more to, in some of their metrics, pre-pandemic era levels of growth. This is obviously, still a bigger business than it was at that time. For example, in 2019, their net earnings were around 11 billion. In 2024, their net earnings were almost 15 billion. This is a company that's still growing, still profitable. Its cash position looks good, still exerting its commitment to its dividend. Growth has slowed from pandemic heights, but I still think that there's a valuable underlying business there. I wouldn't expect this to be a high growth driver, but I think as a dividend investment and as more of a value-oriented business, there are some green flags for the business to consider.
Thank you for that, Rachel. I can take another question here. About 3 days ago, Sadaf asked, it was a question towards Seth, but I definitely could share my thoughts here. Do you have any concerns related to ASML's decision to open Beijing facility? Also, it seems like China makes up about 36% of its sales, which was around $10.2 billion. So for those that are not familiar, ASML is one of the producers of a semiconductor equipment. In the semiconductor manufacturing space, there's a lot of steps. The step that ASML focuses on is pretty much a monopoly with their lithography machine. There's two types of machines there. There's extreme ultraviolet, EUV, and direct ultraviolet. Right now, due to export restrictions, ASML can't send EUVs, which is the most advanced, to China or to any kind of like restricted area. And the main reason they concern kind of national security risk. And I kind of talked a little bit about it that that's why one of the reasons I wouldn't invest in semiconductor companies in China, because they do have kind of they can't get the best of the best products. Now, ASML can still send their kind of lower level machines, which are still pretty amazing, and that's the DUV machines. Now, in obviously we've kind of seen this extreme tension rise, or at least in the media, we've seen an increase in tensions between the United States and China, especially in the semiconductor industry. And in between all these tensions rise, ASML kind of showed that they are building a facility in China, but it's not a facility to manufacture anything new. This facility is going to be more of like a repair center. And I think it makes sense. I really wouldn't be too much worried. Is a lot of those machines already there are mature products, the ones that are legally able to be sent to China. And if you do have kind of a mass amount of consumers or equipment in the area, it makes sense to have kind of a repair facility there, because you're going to be able to keep your customers there happy. And one of ASML's kind of revenue driver outside of selling the machine, because these machines are so so complex, they are one of the few that can only repair them, have the maintenance plans for them, have the replacement parts for them. So again, I think it makes sense for them to build that, to have kind of that inventory there, because what if they kind of, you see more tariff prices increase, maybe you see tariffs between EU and China, having to kind of ship those components all the way to China might not make the best sense for them. It might just make more sense for them to kind of be able to handle everything inland there. So I don't think ASML is doing anything bad here. I do believe they're going to continue to follow these restrictions. It's more just a repair center. And with them kind of having 36% of sales, during a lot of semiconductor equipment companies tend to have China as a big customer, mainly for those mature nodes. It's usually not for anything in the advanced space. China has a lot of players that build automotive chips, that build memory chips. And we kind of saw a lot of Chinese companies saw like an upfront of purchasing, worried of maybe more export restriction laws. So in the past few years, we've kind of seen an uptrend in that. But every semiconductor equipment companies has mentioned that in the upcoming quarters and in the upcoming year, we will see those numbers go back to historical levels of where China usually is. And I do believe it's still at least about 20% of total revenue for a lot of these equipment space. So I wouldn't be concerned on just a repair center. If it maybe was more something like a manufacturing center, I think that would be a different story. But at the moment, it's not.
There was a question I wanted to also hit from Ed about restaurant stocks that came in a few hours ago. I thought this was interesting as I talk about a lot of restaurant companies on the show here. Ed was saying recently many restaurant stocks have been on a downward spiral. What is the number one reason for that? Recession fears or earnings? I mean, this is a very, very broad space with a lot of different companies in it. And some of these companies, in terms of share prices, are faring far better than others, and some of their businesses are faring far better than others. But to kind of give some examples, it is a bit of a mixed situation, right? So you've got a company like Chipotle, they're down about 10% over the last year. Kava is another big one that we get a lot of questions on. That company's down about 30% over the last year. Dutch Bros is another, I think, widely followed stock in the space. That stock's actually up 84% over the trailing 12-month period. Then you look at a company like Sweetgreen. Shares are up about 7% over the last year. Yum Brands is another one. Shares are up about 13% over the last year. Darden Restaurants, which owns a lot of different restaurants, including Olive Garden, shares are up 8% over the last year. Brinker International, which owns, I believe, Chili's and Maggiano's, they're up 190% over the last year. Then you've got a company like Portillo's. That company's about 30% up year to date, but down single digits from 1 year ago. And Starbucks is another widely followed one. I mean, not quite a restaurant stock, but somewhat adjacent to the space. They're trading up about 9% over the last year. So I list all these different companies and share price movements. For one, I think to illustrate that it is very much a mixed bag in terms of performance when you're looking at this space. But that's where share prices are. Where the businesses are might be a very different story. And that really comes down to a very, case by case situation. We talk about Chipotle a lot on the show. I like that business. I think that they are in, fantastic shape. I think I find businesses in this space like Kava, Dutch Bros really compelling. Sweet Greens is one I've talked about, but they continue to be unprofitable. That has kept me most definitely on the sidelines. I like Starbucks, especially as a long-term dividend investor and someone that also likes to add some more value-oriented businesses to my portfolio. But they've really been dealing with some struggles over the execution of their business over the last few years. That's kept me on the sidelines. So it really does depend on the business. All of these, tickers I mentioned, it probably was that about 10 companies. Roughly half of them are trading down over the last year. Roughly half of them are trading up, some by a notable amount over the last year. It really, really depends on the business. And so I think when you're looking at this space, I think it's important to kind of take a case by case approach and then look beyond their share price movements at the underlying business. Some of the companies that seem to do really well, even in the volatile markets we've been seeing recently, there might be some concerning metrics, but it just might be that, because earnings or net losses still came in above what analysts have been projecting, you see an uptick in the stock. So I do think it's really, really important to look at the individual businesses and see, how they're performing. Now, in terms of volatility that's being seen in this space, I think for some companies, it comes down to a function of earnings. I think investors, do not like uncertainty. We've seen that even more so in the markets recently. I think companies that are unprofitable or are struggling with growth are often met with the ire of investors, if you will. I think in some situations we're seeing companies like Brinker International was an example. That's a standout one. That one's up about 200% over the last year, which is considerable share price appreciation when you just look at the general trajectory of stocks in the space. That's a company that's doing really, really well from a financial perspective. They're growing the top line steadily. They're very profitable. They're seeing exceptional interest and retention in their core businesses in terms of customer foot traffic. And that is a business that I've been more, intrigued by recently. So I think sometimes you see it as a function of earnings. I think sometimes you see it as a function of broader market sentiment. Some of these companies that are reporting pretty solid results, like Chipotle is a great example, and shares have floundered a bit recently. I do think that there's concerns about recessionary pressures that weigh into some of the performance of these companies. But I think it definitely underscores the reality that it really depends on the business. And while there are some businesses in this space that are under pressure, and perhaps even for a good reason in some cases, there are also a lot of stocks that are still broadly performing well. And even more importantly, I think a lot of businesses in this space that are still financially performing well. Now, I think it's very realistic to expect more pressure and more volatility if consumer spending patterns worsen, if the economy was to, take a turn for the worse. I think that's inevitable. This is, not an industry that is a investable option for everyone. Not everyone's going to be drawn to the cyclicality of this space. But I think for anyone looking at the restaurant stock space, there are a lot of these different, types of dynamics to consider.
Rachel, quick question here in the restaurant space business. Do you think maybe investors should kind of keep a closer eye on some of these deliveries, like these Uber Eats and stuff like that, as you kind of have like that added fee there, and people might be like, you know what, instead of kind of maybe paying for the fee here. I'd rather just go in restaurant where I know it might be a little bit cheaper, but then you have to include tips. So I wonder if there's any correlation with maybe what Uber Eats might present and kind of, or Uber might present, or these other kind of food delivery systems might present, where we can kind of translate that information into the food industry.
Yeah, I think that's the case. I think also it's a different way, right, to invest kind of indirectly in the growth of restaurants and consumer spending. I mean, with a company like Uber, I think there's so many different reasons to look at that stock beyond its food delivery segment, right? And I do think any growth that we see in terms of numbers that are parsed out in Uber Eats can tell us about how consumer spending patterns are shaping up and what the inclination is of the consumer, and I think that's really valuable. Then, of course, you've got just the flagship Uber business itself, which I find really interesting. So I do think there's some data there that can be parsed out for sure. And some of these other headline numbers that we talk about in terms of consumer spending and consumer sentiment can also be helpful. But fundamentally, I think it's also looking on a case by case business at how some of these companies are positioned over the next 5 to 10 years for anyone that's looking at investing in this space. There's a lot of kind of unprofitable or highly evaluated for no great reason restaurant stocks. And then there's some of the ones I mentioned, which I think, can be compelling if this is a space that someone is looking at to invest in.
Thank you for that, Rachel. And we have a few questions coming in the past few minutes. So maybe we can take some of those. So about 10 minutes ago, For the Bees had more of like a general investing mindset. And For the Bees, do you think differently about business sectors and picking stocks for yourself versus your parents, grandparents who still need to grow money in retirement? For the Bees, I'm gonna say for me, yes. With my portfolio, right, I tend to invest a lot in individual companies, especially in the semiconductor industry. But whenever someone like my parents or even like my younger brother come to me and say, "Hey, look, I'm looking at my 401k. What typically would you do?" I very rarely, Rachel, tell them about any individual stocks. I would just say, "Hey, if it was just me and I'm someone who didn't really." Just wants to see my money grow over time and doesn't want to really not risk, but take the time to maybe listen to earnings calls every so often or stuff like that. I would just do uh, a blank index fund, either being kind of like a S&P 500, the Qs, or there sometimes I kind of just mention a semiconductor ETF, but more again, kind of like that basket approach. And it's very completely different to how I do it. Even for my little one, Rachel, I opened up a 529 for him, and pretty much
Mm,
is all a S&P 500 or a
mm.
Q index fund, and that's it. For me, I don't mind taking the risk, but for anyone else, even my little one, I think the safest and the best approach for me to ever say is an index.
Yeah, no, that's a great question. And I mean, I've seen that bear out even in my own family. I'm a much earlier on in my investing journey. I'm still really growing out the basket of stocks I want to hold. I still don't have anywhere near the number of holdings I want to have over the long run. And I am comfortable with the risk of investing in individual stocks, which is certainly not for everyone, right? And that has been something I've been, willing to take on, including in, more volatile industries like tech and some cyclical spaces, because based on where I'm at in my own, personal finance journey and my own long-term goals and how far I am from retirement, which is quite far, I'm very much willing to take on that risk. My parents are, much older. They are retirement age. And they have, broadly invested in index funds and exchange traded funds. And that's also been something when we've talked about investing that when we talk about that, I'm like, you should look at these because I agree with you. I think that there is an element there where, especially depending on where you're at in your investing journey, how much time one has to really dedicate to the business of researching individual stocks and getting to know those businesses inside and out, which is a very time intensive process. It's not for everyone. And I think that that's something that has, I've seen that for people in my own life, including my parents, been a rewarding approach to investing that has also yielded generous returns, but again, taking that more basket approach. I know people like myself, colleagues and friends as well, who prefer individual stock picking. I also know people who would never invest in individual stocks that are, also, much younger like myself, but they prefer the basket approach and they like to build out their portfolio that way. So it really is a very personalized thing. But yes, I think that the way I think for myself and my portfolio is very different than maybe even how I would also be thinking if I was, 20, 30 years down the road in my investing journey.
And I also want to mention that for my parents and like for my brothers, another reason I kind of just do this index approach when I discuss with them is they just don't have any real um passion, I would say, like maybe like the full universe where we kind of enjoy learning about different companies. For them, it's just something that they want to set, forget, and never even really think about. So
Right.
I think that's also another important thing that I forgot to mention is if they were maybe part of like, if they wanted to learn more about individual stocks and have like that passion, like a lot of us fools here, then I would definitely talk to them more about individuals picking and just kind of just say where I normally look at. But since for them, it's definitely not a universe they want to be into. So I think that's another reason why I go with that ETF approach.
Yeah. There was a question that came in. I know we've got about 8 minutes left in the hour, but there was a question that came in a couple days ago from Vihan that I wanted to hit. One about a company I'm familiar with and started following a bit more recently, and one about a company I actually didn't know, but something I do a lot here on the show is if I can in real time, I'll learn a bit about a company and then talk about it. So Vihan was asking thoughts on Braze and Grab at current levels. So Braze is a roughly $3.7 billion market cap stock. Shares of the company are trading down over the last year. Price to earnings is not a useful metric with this business because, as far as I can tell, they are not profitable, or at least not consistently profitable. So that's something to be aware of. From a price to sales perspective, though, Braze trades at about 6.3. And then Grab, and I'll explain briefly what these businesses are in a minute. Grab is a much bigger company. They have a market cap of about 18 billion. Shares are actually up about 40% over the trailing 12-month period, which I think is worth noting. And I believe they are also working to be more consistently profitable. So they trade at a price to sales of 6.3. Braze, they are a customer engagement platform. They help businesses create personalized and relevant experiences for customers, like email, push notifications, in-app messaging. So they're a software as a service platform that helps brands build stronger relationships through consumers through data-driven communication. So let's say you're an e-commerce brand and you have different ways of communicating with your customers through in-app messages or email. That's something that Braze could help with. They support channels like email, push notifications, in-app messages. They offer a range of AI-powered tools to create personalized experience and content. And they also provide real-time analytics and insights to optimize campaigns and improve customer engagement. They have that classic subscription model where businesses pay a recurring fee to use the platform. It looks like Braze has been doing a pretty good job of growing their revenue, but they are still not profitable. Their revenue was 152 million in their most recent quarter that they reported. That was a 23% year over year increase. They reported 146 million of subscription revenue compared to 118 million a year ago. And their dollar-based net retention for all customers in the trailing 12 months was 113%. So pretty solid. They also noted that their cohort of customers that had annual recurring revenue of 500,000 or more ended the quarter at a number of 234 compared to 189 customers a year ago. Still operating at an operating loss as well as a net loss under GAAP. They work with a wide range of businesses, including companies like Crumble Cookies, Hugo Boss, Exact Sciences, and Lush Cosmetics. So a wide range of customers and industries represented there. As I mentioned, this was not one that I knew before looking into this on today's show. So, and again, looking at a metric like price to sales is more helpful for this type of a business because they're not profitable. I think it's interesting just at a first glance, given their consistent unprofitability, as far as I can see at this point, this wouldn't be one I would necessarily want to take a position in right now, but I might add it to my watch list. Grab is one I've actually been a bit more intrigued with recently. They're based in Singapore. They're a multinational tech company. They operate as basically a super app that offers ride hailing, food delivery, and digital payment services across Southeast Asia, with a focus on mobility, delivery, and digital financial services. They were founded in 2012. They make money, for example, from commissions from each ride that's booked through its platform, and that commission can be anywhere from 16 to 25%. They earn revenue by charging restaurants a service fee for orders. They also earn transaction fees, revenue from interest income on loans and factoring fees, and commissions from other financial services they offer. I haven't historically invested that much in companies in Southeast Asia, but I have been more intrigued by doing so recently, and this is one I have been watching. This is a company that has been working to become more consistently profitable. They just turned an operating loss 1 year ago into a very small operating profit in the final quarter of this last year. They also actually delivered positive operating cash flow compared to negative operating cash flow a year ago. They're still operating on an adjusted free cash flow basis. So this is what I'm following. But again, given their ongoing profitability struggles, is what I'm watching from afar for now.
Yeah, Rachel, I wasn't too familiar with Braze and what you were kind of discussing. I did a little bit more research on it, and it seems like the overall excitement. Well, the first thing that came into mind, and kind of saw kind of like that, marketing solutions and kind of the growth in that space. The first company I was like, isn't this something that maybe Salesforce might do already? So you kind of do have a lot of players already kind of focusing in that space, but it seems like Braze, they're trying to take this AI advantage and move a lot faster than maybe some of these big tech players. And sometimes being a smaller company, having smaller market share, you're able to be a little bit more risky with kind of adding AI into your own products. As with a big company like Salesforce, I think it's not that they're scared, but they just have to be more cautious because something that might work for one customer might not work for another customer. So you have to be maybe a little bit more patient with AI integrations. But I guess Salesforce being a smaller player, they are kind of leading in that customer relations. Not customer, I meant marketing
Mhm.
relations, and that's completely different. So Salesforce does have like a marketing suite, but I was looking at that there might even be some ways that they can kind of work with each other. But I believe eventually you're going to have some of the bigger players integrate AI solutions into these marketing pushes as well, where competition is going to be something that in the long term will be something that investors need to really, really be careful about.
Yeah, I think that's right. All right, we've got a couple minutes left. I don't know, looking through the queue here, if there's anything that you want to grab really quick. I'm also looking.
If anything, a question about 8 minutes ago from Fool's Quest, or a little bit longer ago, with the EV market growing, should we keep an eye on EV charging stocks? Um, this is definitely maybe a market one should look at, but Rachel, I kind of tend to hesitate here because
Mm,
just like in any other industry, there's going to be a few winners. Not everybody is going to be a winner in this space. We kind of saw it with the EV business in early 2020, where so many EV businesses come up, and now some of them aren't here anymore. And I think the same is going to happen with EV charging businesses. As a semiconductor investor, what I kind of tend to look at more are semiconductor companies that can benefit from EV charging stations, where it doesn't matter which EV company, EV charging station wins, as long as that winner continues to grow overall, they will kind of need those solutions. So, again, just maybe I'm biased in the semiconductor space, but bullish in EV charging and EV charging market growing. I'll look at stocks that provide power solutions for the automotive market instead.
awesome. Well, and with that, we have come to the end of our hour. It flew by. Jose, I think you're sticking around for the next hour, right? And I believe Neil is coming to be your co-host for this next hour of Fool 24. What are you guys going to be talking about?
I'm gonna guess we're gonna be talking about chips and tech. I can't see anything else. Uh, But yeah, Rachel, it's oh, there we go. Hey Neil, how's it going?
Hey guys, how are you?
Hello. Good. How are you, Neil?
Very good, very good. Yeah, we're probably going to talk about fish and chips. I mean, tech and chips.
Well, with that, gentlemen, I'll leave you to it.
Thank you, Rachel.
Bye bye.
Welcome, fools, to another episode here of Fool24. For those that are just tuning in, my name's Najarro. I do focus a lot in the semiconductor space, but I can cover thoughts in the tech industry. And today I am joined by Neil. Good morning, good afternoon, Neil.
Good evening as well. How are you? How's everything?
Pretty good. And Neil, before we get started, for everybody watching either on YouTube or on the Motley Fool platform, if you have any questions, make sure to go to slido.com and enter code Fool24. Neil and I will be on for another hour or so, and we have other kind of hosts throughout the day coming in as well, with different types of research expertise, some following more specialized markets, some being more general. So even if we might not be able to answer it right now, if you get those questions in, someone along the day will be able to answer. So Neil, starting with that, we've had an interesting week. We had some really good and bad earnings this past week, but in a few days, the market opens back up. Is there anything, Neil, that you are kind of excited about for the upcoming week, except hoping maybe our stock prices continue to go up after that strong finish on Friday?
Yeah, I think not. I mean, earnings season is over, I'd say. I mean, there still is Micron and Nike, two big names, I think, that we follow that are reporting next week. I think Neo as well. Other than that, yeah, remains to be seen if we can continue this strong performance that we've seen on Friday, because we've had these types of days before, right? We've seen one great green day, but then it's followed by a red day. So we're up 2% one day, then down 3% the next day. Didn't really do much with that. So let's see if we can see some continued strength. Maybe the market might have bottomed, maybe not, remains to be seen. But other than that, only Micron, Nike, and Neo are on my watch list at the moment. How about you?
So I talked a little bit about it with Rachel, so excuse to the fools that might have been watching the last episode. But for me, Micron definitely, Neil, right? I mean, they're a big semiconductor company. While maybe they might not be as popular as kind of like your NVIDIA or your Intel, memory is used in every form of technology, right, Neil? So they give us a great insight. I would say, even if you don't own Micron, or even if you don't own semiconductor stocks, when they report earnings, check out their earnings presentation. They usually have one slide or two slides explaining how they see every industry right now. They kind of have a segment for the automotive market. They have a segment for the cell phone market, for the PC market. So if you're an investor, I'm pretty sure you hit one of those markets, and they can kind of give you a great insight of what that space is looking at right now. Very great overview. So, and obviously, Neil, if you're an AI investor, they're going to talk about their HBM solution. How is that growing? How's the customer demand? So we can kind of get some updates on the AI space there. Outside of that, Neil, I want to say Adobe is having their AI Summit event on Tuesday, and that stock took a massive hit after reporting earnings this past week. I wonder if they're going to show more AI solutions during that event. Now that one might be overshadowed. It might be, not many might hear about it because it's actually happening the same day that NVIDIA is going to do their GTC keynote. And that's the one I'm super excited about, Neil. I think we're going to get a lot of pretty cool updates about the AI space. And Neil, even if you're not an NVIDIA investor, I think the GTC event is great because they do have a lot of conferences, a lot of presentations about how AI is impacting various industries, from cybersecurity, from autonomous vehicles, from the healthcare, from the digital landscape, and the list goes on and on. So a lot of knowledge can be absorbed next week.
Yeah, no, I agree. I think I actually almost forgot about GTC, but a pretty big deal, I think, in today's market. And I think whatever gets mentioned there, I think it's going to be positive because there still is quite a lot of momentum with this whole AI story, infrastructure build out. And I think the more information that we'll get from that event, that could trickle down to the names of the big seven, right? The Magnificent Seven. If you look at the average PE, it's the lowest it's been since 2017. So either they go out of business, or there is something wrong here with the market. So I don't think they're going out of business. So that might be one of the events next week that could push the market into green territory in the next couple of days.
And Neil, just a quick confirmation: was it current PE ratios, or did you mention forward PE ratios are lower than it's been since 2017?
I will find it again to make sure that I did not misspeak. But even if it's forward or trailing, it still is quite astonishing. But I'll try and find it and make sure.
Yeah, I mean, even if it was forward, I mean, forward is just within the next 12 months. And again, these numbers are based on analyst expectations. And I think with at least the big seven, those analysts are pretty close with usually kind of having the answers with it. So even at a low PE ratio, even if they might have overestimated a little bit, I think it's still very attractive. And it's crazy, right? Some of these companies are, well, the Max 7, most of them are in the $1 trillion market cap. And I still believe that they can continue to grow from here.
I agree. I think it's current P, because they don't write forward P. So I would assume it's the current P that they're at right now.
And we actually got a question here that just came in, and I think maybe you might be able to answer this one. Oakville dude came in about a minute ago. I appreciate if you can share thoughts on the pavement space, such as Four or DLO, which both are under pressure right now. So I know you follow the fintech space, Neil. I don't know how much you follow these companies. Any thoughts here?
Yeah, so I follow and I own the local. I don't follow Shift4 that closely. I know Jared, which is the CEO and founder, he's supposed to go to NASA. I don't think he has been voted in just yet, but I do think that he is leaving the CEO post at Shift4. The local specifically is a Latin American name, so they're exposed to the emerging markets when it comes to cross-border payments and all of that. It's true that the stock itself has been under pressure, especially after the last earnings report. As for Shift4, let me just check what the stock has done. It has also taken a hit more recently. I think the last earnings report, the stock went down because I think guidance was a bit light. Market was expecting a little bit more, but they're still growing. They're still growing quite quickly. And the same for dLocal. It's still growing. I think dLocal's TPV is expected to grow 25-30% or so year on year. It's a small company, market cap $2 billion or so, a little bit more than that, but already profitable, growing quickly. They say they're willing to take a take rate hit, but they're going to make it up through volume, TPV volume, which, okay, maybe the market is like, you're saying this, but we would like to see the results first. But then again, at the current prices that you're paying, size of the company, they're growing quite quickly. They are profitable. I don't think there are many companies of their size, their profitability that exist in the market. So it's true, they've been under pressure, and they're not the only names in the fintech space that have been under pressure. Still very good companies. Shift4, I'll have to dig a little bit deeper because it's been a couple of months since I've looked at that more specifically. But yeah, just because the stock is down does not mean that something is really wrong with the company. I think Shift4 over the last year is still up. Of course, it's down year to date now 22%. So yeah, maybe a shift in sentiment, pun intended, by the way, but still a very good company that is growing quite quickly. And I think there is a space for them in the fintech space. There are quite a lot of players, but I think Shift4 has their niche.
And yeah, I wonder if maybe you can answer this. It seems to me that there's so many different players here in the payment space. How can there be so many competition in this space? And with so much competition, does it add like pressure on like pricing? Because I'm pretty sure some of these have like fees. Like, doesn't this make, oh look, I'll just charge less fees? And why wouldn't a player go from like Four to DLO? I forget what this company is, but what is kind of like the moat you see with these digital payment platforms, especially?
Yeah, so no, you're right, and which is why we're seeing with a lot of these players take rate go down, right? Take rates for PayPal, for a lot of these other players as well, the huge ones, you see take rate come down, but they're all saying the same thing. We're like, okay, you know what? Take rate is coming down, but we're making it up through volume. So the more transactions that are made, the better it will be for us. Now, the fintech space, the payment space is quite big. So some companies are focusing on, for example, the local DLO is focusing on emerging markets. So some countries in Nigeria, they're focusing on Egypt, of course, Latin America as well. So that's their niche. There are other companies out there that are focusing on other markets, bigger markets, more established markets. For example, the Adyen, the Braintree, Stripe, for example. And then you've got other companies that are going after restaurants, hotel chains, casinos, and all of that. You have Shift4, you have Block, Square, previously new ticker symbols every single week. You have these types of players, Toast, Clover, for example, point of sale systems. So you have different players in different categories of the payment industry. Now, of course, there is competition. Not a lot of these companies have a moat. I think those that have a moat are the largest ones, the ones that have a lot of data, a lot of users. Whether people believe it or not, I think PayPal has a huge moat in that segment because they have both sides of the ecosystem, the merchants, the consumer. Still, millions and millions of users are transacting on it, trillions of dollars. So you have big players. The moat is probably the exposure, the profitability of your business, the data that you have, because the take rate is coming down. So that's not a moat anymore. It's all about, I think, the volume and the value that you provide to the customers. And it would not surprise me if we're going to see some acquisitions in the future, merger and acquisitions in the future.
Actually, that was going to be the next question I was going to ask you, if you think we were going to see maybe this list get smaller and smaller. And again, maybe one more final question, if you don't know, it's okay. But are these companies usually come up? Because I would say if PayPal or Square or some of these other players are already in the region that I'm in, it would be very hard for me to even attempt to build a company to kind of fight those players. Are these players mainly rising because maybe those big players haven't hit that market just yet? Or kind of what is giving them the ability to have all these players?
Very good question. So, I mean, Stripe, Braintree, PayPal, Adyen, they are, I would say worldwide. Yeah, I would say worldwide companies for sure. But most people know PayPal just because of that checkout button. Although PayPal has Venmo, PayPal has Zoom, PayPal has Braintree, which is basically an equivalent of an Stripe and Adyen payment processor, but you don't really see that because that's in the background. So the other companies are basically coming in and saying, look, for example, a Block, a Square, the solution Square, or Toast or Clover, they're going to go to restaurant chains, to hotel chains, and like, look, this is the ecosystem that we've built. We think we can offer you a better product, a seamless product, seamless experience, and all of that. Pricing wise, I think we can work on it if you buy the suite of our products and applications, etc., etc. We think we can do this better than the rest. Now, for the other companies, for example, let's put Amazon here in the conversation. And Amazon can enter various categories if they want to, right? We've been talking about Amazon and Hims and Hers, for example. Could they enter the telehealth space, that type of thing? They could, if they were really interested in growing that. I think a lot of the other companies, the bigger ones, they're focusing on their big markets. And the smaller ones are taking a chunk of the pie, a little bit here, a little bit there. But yes, eventually, if the big players want to, they could enter those markets eventually, for sure.
Neil, I think we can probably jump to this one as a follow-up to here, so we can kind of stay in the fintech space. Rose, 2 minutes ago, how do and kind of these payment platforms impact companies like Visa and MasterCard? So on a top level overview, I would have expected things like this to be kind of bullish for the MasterCard and the Visa. Again, I'm not too familiar with the space, so let me know if my thinking is wrong. But now it kind of allows all these vendors to accept some form of credit card. And those credit cards usually have kind of, or Visa and MasterCard have like some form of fee. So I would say kind of would be beneficial for them. But I was also kind of looking online, and it does seem like a lot of these players also try to kind of combat some of the fees that Visa and MasterCard might have. So it seems like there might also be some tensions between those players as well, even though it is kind of positive for MasterCard and Visa.
Yeah, so you've got the payment rails, the usual payment rails, right? That they've been dominating for a long time. But then you have players like Block, for example, and they've been quite clear for many years that they want to tackle that fee problem that Visa and MasterCard have created, right? If you use the credit cards, it's not cheap. So one way to tackle that is stable coins. So you can create a stable coin, and that's basically your payment rail. So you're basically having higher margins. If it works out, right, you need the volume for it to make sense. That's something that PayPal is working on with PayPal PayUSD, for example. With a Block so far, I mean, for a player that's been so focused on crypto, right? Jack Dorsey has been a crypto maxi for a long time. They are falling a little bit behind, right? If you're looking at Bitcoin trading, I mean, Robinhood, Coinbase are by far the leaders there. And when you're looking at stable coins, I don't see it yet for them. So how do these players impact the Visa and MasterCard? To be honest, I think not much at the moment. They're not, on the negative side of things. On the positive side of things, of course, as we move even further from far away from a cash society into a cashless society, players like Visa, MasterCard, American Express as well. I think American Express is an exceptional business. They're going to gain more and more from that. I'm, of course, a big PayPal bull, so I think that the PayPal stablecoin is going to be used more and more, which would make sense. It's cheaper for a merchant, it's cheaper for a customer, or if it's a huge payment and an investment, you can use that using a stablecoin. It's faster, it's cheaper, and it's very secure as well. So we're going to see things change, but I don't see how it's going to negatively impact a Visa or MasterCard, unless, of course, there is going to be a new law that could cap interest on credit card payments and all of that, on credit card interests. But yeah.
Because again, this maybe this is something we can discuss later on, but I was just kind of seeing that there was kind of like this lawsuit where it happened here around 2020 recently, actually, where TOL CFO weighs in on Visa card and MasterCard settlement, which is kind of something for these players to lower their interchange fees by the second half of 2025. So they're based on some of the articles I'm reading here, Neil, it seems like because of this settlement, you might see like a trimming, I'm not sure how much, of some of Visa cards and MasterCard's fee income from some of these interchange costs. And is that what you were also talking about, Neil, with kind of like what stable coins can help out with like that fee that they might charge?
Yeah, no, exactly. It's basically a margin expansion product. If, of course, everybody's using it. But if you own it, if you own your own payment rails, you can still charge a small fee, but that's a fee that is less than a Visa and MasterCard. You're going to win, right? You're going to win. Now, on the flip side, you can say, okay, Visa and MasterCard, I don't see how they're not thinking about that as well. So maybe they're going to work on that. So we'll see. I don't own a Visa or MasterCard or a Shift4. I only own from that list the local at the moment, and PayPal, of course, and SoFi as another fintech name. But Visa and MasterCard, I think American Express have taken a hit more recently. American Express is a very interesting one because American Express is that, I would say, exclusive club, but it is a club, right? You have to pay to be a member of that card. You get a lot of perks from it as well. So it's an interesting model to look at, compare it to a Visa and MasterCard.
Thank you for that, Neil, and sorry for sending all that questions to you. But this is definitely a market I don't follow, so I think the viewers and I kind of had similar curiosity. So Neil, we got a question from Vihan about 9 minutes ago. Neil, Jose, and Vihan list various semiconductor ETFs. Appreciate if we can rank the ETFs, and then kind of the thoughts on ETFs versus building semi-stock portfolio. So Vihan, first, in forms of ranking the ETF, I think it would all matter in the way the ETF is kind of built. Some of the ETFs that you mentioned, Neil, Vihan, holdings are completely different. Some of them just kind of hold like the top 25 semiconductor companies, and have like different weighings. Others have a more like a true equal weight and just multiple, like more than 50 positions, all below like 2%. I think as an investor, you want to be, you have to decide what you want to go. Do you want to go with a little bit more concentration with 25 positions? Do you want to go more of like a true index approach where it's more than 50 positions, all probably less than 2 to 3% of the portfolio? And I think that's more of an individual decision. I personally, Neil, when I go with the ETF approach, I tend to go more with those that have concentrated holdings, just because I look at those holdings and they're holdings that I'm very excited about. Then kind of ETF versus building semiconductor stock approach. I think just like any ETF, right, Neil, it's again more of like a preference for the investor. I am like super excited about the semiconductor industry. I like to research the semiconductor industry. So I like to pick my players for each segment. I like to pick my players for the AI space. I like to pick my players for the automotive, for the equipment markets. But that's because I do the research and I enjoy kind of doing that throughout time, listening to the earnings call. If I didn't, I most likely would just go with the ETF approach. Now there's pros and cons. The pros with the ETF approach right now is you don't have to worry about picking stocks. You don't really have to worry about listening to earnings call. Some of the risk is maybe you might not get the type of gains as one would get with individual stock picking. But that's not I wouldn't consider that a semiconductor ETF versus semiconductor stock picking. I think that's just a universal truth to all types of markets. And then kind of the building individual semiconductor stocks is you could be right about the market being bullish, but you could have been wrong with the stock that you chose. So while the whole market can go up, you have a higher risk of kind of stocks going down as well. So yeah, Vihan, I don't think there's ever a right or wrong answer here. I think it's just a preference of, hey, do I enjoy listening to these earnings calls? Do I enjoy kind of seeing maybe my risk increase by maybe I might be wrong, but if I am right, my returns could be a lot higher. And any thoughts there, Neil, or any different approach that you might see?
No, I agree. I think when you go with an ETF, you want to sleep maybe better at night. You don't want to be a stock picker. You don't want to go with individual names, like follow them quite closely. And that's fine. You have to choose, of course, the right ETF. You can look at the holdings, the percentage, and if that one fits your philosophy or your needs of the portfolio. On the flip side, if you wanna hold specific stocks, individual ones, you can basically create a mini ETF inside of your portfolio, right? Buy a couple of those semi names, and that's basically becoming your mini ETF inside your portfolio. If you like an ASML, if you want exposure to NVIDIA or TSM, you can buy all three of them. Add a couple of other players in that industry, so you get that exposure, but at least you're the one deciding which one goes into your portfolio and which one do not. Because if you buy an ETF, sometimes you say, okay, I like the holdings. I like that maybe Broadcom is number one, then NVIDIA number two, and then an ASML number three. But maybe 6 months from now or a year from now, that changes, and you're like, actually, no, I don't like the exposure to that. So yeah, it's really up to you what the investor wants to do, basically.
Yeah. And Neil, the other I forgot to mention is there's nothing wrong with doing both, right? I actually do both, Neil. When kind of downturns like we've seen in the past few, I tend to focus more on individual stocks. But when we're kind of seeing a nice rally up, and sometimes I get worried. I'm like, hey, look, maybe some of the semiconductors I stock, I don't really like the valuation at the moment, but I still want exposure to the semiconductor space during that time frame where and I think for every investor it's different. Sometimes I'm like, maybe I don't feel comfortable buying an individual stock, I tend to just focus in the overall ETF. And then the other way around, now that I kind of see more attractive in semiconductor individual spaces, I tend to do less ETF approach and more individual approach.
Yeah, no, fair enough. Let's see. We've got one. I don't know if you follow the trade desk, but we've been getting a lot of questions about the trade desk more recently. One from Charles 47 minutes ago. What's your opinion on the trade desk? Hold or sell? So there's no buy option here in that question. The trade desk got hit a lot more recently, especially after the last earnings report. I believe year to date, the stock is down, let me check, 54%. It's down 55% since, well, a month ago. So they reported earnings and it was their first miss in 8 years. So quite incredible performance. First miss in 8 years. They missed guidance, but they missed their own guidance. And that was, I think, the big issue here. Plus, for being honest, it was an expensive stock at $120, $125 or so. It was an expensive stock, so anticipation expectations were sky high. Now, today at $53, $54 or so, it's not the cheapest stock out there, but it's way cheaper than before. And I think one bad quarter does not break the whole thesis. I think their performance, their track record speak for themselves. And one of the reasons why they missed was because of it. The Kokai is their new AI advertising product that they want to launch. And that one was delayed. So they said, look, on the one side, we could have launched it on time, but we knew it wasn't perfect. So yes, it could have collected some revenue for us, but we wanted to delay it, make sure that when we launch it, it is perfect. And so that's why you're seeing a hit here with the numbers. On the other side, there's also some reorganization happening inside the company. They want to add a little bit more expertise to the teams. They want to add more executives as well. And I think in the last couple of days, they added if I'm not mistaken, a COO, basically a high-level executive to the team. This is something that they're working on. So hold or sell. This is not personal advice, but if I had it, I would definitely not sell at the moment, right? After being down 50+%. It's a very good business. The stock being down so much does not change that at all. It would actually make me want to have more shares than previously because it's much cheaper. The thesis is not broken. They're still on track to grow. This is a market that is growing extremely quickly. So yeah, hold is a minimum here, I would say.
Yeah, Neil, no thoughts on from me here, but pretty much like you mentioned, I think I would listen to earnings call, see if the thesis is broken. And it's very rare, right, Neil, for a thesis to be broken in one quarter. I would have to see what were some of the headwinds that they were facing right now. But again, you mentioned valuation. And I think as long-term investors, especially early on, and it might be different for those that might have like already a major position, but usually when you kind of enter some of these stocks, you would like your dollar cost average to go down. So if you recently purchased, obviously things look a little bit more attractive here. So I think the first thing is, take a closer look at some of the research that might be coming out, either via Fool platforms or taking a closer look at their earnings transcript and see what the major hurdles were, what kind of cost is. Was it just a valuation concern? Was it just a minor miss? Or is there something else in the background? And if nothing breaks the thesis, like you mentioned, I think hold would be my minimal thing to do. But every investor, not personal advice, just what I would typically do. There is a question that came in about an hour, 3 hours ago from For the Bees. For the Bees mentions that they noticed acceleration of digital medical world, recently receiving billing with QR codes, options, and then For the Bees want to know, is this Zebra or what companies lead this form of QR codes, digitalization of medicine building? So Zebra can definitely be a benefactor here, but it's usually a partnership between kind of a hardware provider, which is more what Zebra does, and more of like EHR, which is electronic human reports platforms, and a payment processing platform as well. So I think it's, if you're kind of seeing this overall increasement of digitalization in the healthcare industry, it's going to be multiple players. I don't think there's ever going to be like one player that's going to see the huge boost. And usually it's a very specific market. So it's more like just a tailwind to rise the payment platform, the EHR platform, and kind of the hardware platform. So I think there could be multiple winners here. But I personally don't know of some. I think the biggest winners, if there are ones that are more niche specific in those players, in those industries. And I don't think there's any on the top of my mind right now.
I have nothing more to add because I don't follow Zebra that closely or at all.
Yeah, there's a question here that maybe you can tackle. Came in from Ed about 4 hours ago.
Yeah.
And he mentioned, do you think Tesla gets a boost in price after Musk and SpaceX replace/rescue the astronauts stuck in space for 9 months due to Boeing Starliner problems?
I mean, could happen, right? We've seen these things, these headlines positively impact, negatively impact a stock like Tesla. So it could happen, but does it change something for the business? I don't think so. It's probably going to be a good headline, and at the end of the day, the most important thing is for them to come home safely. So hopefully that will happen. But I'm not really focused on whether or not that could positively impact Tesla stock. Tesla stock is cut in half, as we've seen. It's now back to prices not seen since the election, and as we've seen, after the election, the stock did double. So we're back to the prices since, I think, November 5th or 6th or so, which makes more sense, in my opinion, than the $400+.
Yeah, and I think at one point we kind of got into like with Tesla, let me just take a closer look into like the 220s in these past few days. And to me, one of the things that I was curious was kind of, we saw $220 in 2021. And I feel like if in the past 4 years, the market was giving this valuation towards Tesla, and I feel like now versus 4 years ago, AI has evolved so dramatically, and these are core products that Tesla can go. The chances of success, not guaranteed, but the chance of success has improved dramatically versus 4 years ago when we kind of saw similar stock price action. So it's obviously in both terms. Maybe in 2021 there was kind of a huge overvaluation at that time. But if someone was willing to give that that valuation at that time, and I feel like chances of success have increased dramatically, I find it kind of enticing.
No, I agree. I mean, it's exciting times. But yeah, going back to the core question, we could see. I mean, if the market did bottom last week, then this could of course push that specific stock higher. But then again, if the market did bottom, then I think we're going to see green across the board.
Yeah, and again, that topic was more of like just overall long term, and agree with you, Neil. This kind of question is more like it could create volatility for the stock price, right? That's, Neil, what you were saying. Positive volatility, but in the long term, it's not something that Tesla investors should really worry about, because I don't think it really adds any impact to the thesis of Tesla as a business.
I agree. I think the focus right now will be on the new Model Y ramping up and seeing those numbers being reflected, because we've seen numbers decline. But then again, when you do a refresh of the best-selling car for the last 2 years, usually you get a negative impact. So the focus now is definitely on the Model Y refresh, and then the launch of the new affordable models. Well, the goal is for mid-2025. We'll see if they'll be on time. Then in June, we have that launch of FSD in Austin. That is also a big focus for investors.
And Neil, kind of talking about that FSD in Austin, or this robotaxi, I was kind of just listening or quickly read through X that I forget what was the analyst. And one of the things that they talked about is for a robotaxi space, that kind of 2-seater doesn't really seem like a viable option, because it might be too low and not everybody will be able to kind of be in there comfortably. Any thoughts? I'm gonna guess you probably read kind of maybe more of that report. Any thoughts on it?
I mean, I've seen plenty of reports, so I don't know which one is actually believable or not. But yeah, I think they know a thing or two about producing cars that are comfortable and would be great for the user. If it's too, I mean, if we're talking about too low, then people would not have bought Ferraris and Lamborghinis and stuff like that, right? Because that's really, really low. But yeah, I don't know. Maybe for some people it might be too low, right? If it is for the elderly or those that don't want to go down that much, then yeah, maybe it would be too low. But if it's for the rest, then maybe not. But then again, we don't know the specifications really of the height of that vehicle at the moment.
Thank you, Neil. I'm going to take this question that came in about 8 minutes ago from Rose. And kind of, I think this was more when I was mentioning when I buy ETFs. So Rose wanted to know, do you ever trim from your semiconductor ETF to reallocate the money to individual stocks? And Rose, yes, that's where usually when I don't find where, and when I find like either I have my exposure is too big in a semiconductor company that I own, or maybe the valuation I might find maybe not too attractive. I still want my money to grow, so I put them in the ETF. And if I see kind of valuations go down, my first approach, Rose, and again, this is just my approach. I'm pretty sure depending on who you ask, they might have their own approach. Normally, I see if things look attractive, see if I can put new money into my portfolio. And that's my first thing, seeing where I can add. Can I increase maybe my weekly, my weekly addition by reducing some of my expenses elsewhere? Maybe I don't want to, maybe I might not travel this year, this month. So I might reduce my travel budget and put it into investing. I might maybe want to reduce my eating out budget and putting more into investing, as I feel like my money would go better spent there. So first I try to see if I can add how much new money I add into my portfolio. The second thing is if I don't have ability to add new, but I want to maybe buy in individual stocks, I do trim a little bit of my semiconductor ETF or some of my individual ETFs, but I still kind of keep them as core positions because, like I mentioned, one of the things with ETFs is you kind of get that safety net of even if you're even you don't have to be right or wrong about the company, right? It's kind of that basket approach. But I do tend to trim from the semiconductor ETF and go into the individual stocks. Again, it all depends. In my individual stock has a position sizing that I want to increase. And I think every investor has kind of like the position sizing and how valuable I find that investment could be in the next few years. So quick answer, yes, I trim to my semiconductor ETF, but I try to add new money first before doing that.
Would you say that the ETF is not the same as a cash position, but could be used as a cash position? Defensive one.
Yes, I think it is, Neil, and I also do have a cash position as well. So first is new money, use cash position as well. And once I kind of have a cash position depleted, that would be my it would be like that cash position that can grow faster if the market is going well. But so it's still exposure to the market, but obviously I have that risk of maybe decreasing during the downside.
Okay, fair enough. There was, and now it refreshed, so I lost the question. Great. Love it. Technology. In the meantime, was there something these past couple of days that surprised you or that you paid extra attention to?
What surprise? Well, Intel's CEO, right, Neil? I think that really did surprise me. I don't know if I don't think we've been in a show together. But Neil, I know you are a shareholder of Intel. So I would rather ask you first. What are your thoughts of this new CEO?
Yeah, so I mean, first up, I think the market liked it. Otherwise, the stock would not have gone up 14-15% or so on that announcement. I like it. I think it's the necessary expertise that Intel needs. So that CEO fits that need. He has a lot of experience in that semiconductor industry. He was CEO of Cadence for 13 years or so. Cadence stock, if you look at the stock, it has gone up, I think, 4,000% since 2008 up until 2021 or so. So I think he delivered. And then he spent 2 years on Intel's board. He did leave last summer. There were some reports that said that he did not agree with the way Intel was being run. He thought they should have cut way more middle management, more specifically. So I like it. I like the announcement. I think it's great to see that the stock rebounded. I think the stock year to date is up 17% or so. So this year, big outperformance. But it doesn't solve everything. This is a great start. Doesn't solve everything. I think I wouldn't be surprised if we see more layoffs for Intel. I would want to see market share gains in the next coming quarters, because quarter I don't think much will change. 18A is supposed to be on time, and I think that could be a game changer for the company. So yeah, I like the announcement. I think he knows exactly what Intel needs and where you need to push this company in order for it to be back on top. Now, on top doesn't mean that it's going to beat NVIDIA and all of that, but a good Intel, like Jim Keller said a couple of weeks ago, a good Intel could be worth $1 trillion in the future.
Yeah, and Neil, the reports that you mentioned, right? It seems there were 3 things based on the reports that Lee Bhutan really didn't agree with. I think the first was just overall, you can trim the business a little bit more. But it does seem like even after he left, we kind of saw those layoffs in late December. I believe we started to see. So I wonder if that's already included. I wonder if he does cut off. The second I thought the reports were cultural change, and like you mentioned, Neil, I think with cultural change, you mainly see cultural change when you change management. So I wonder if that's where we're going to see the bigger change. And the third thing, Neil, is it seemed like he really wanted to push more of he was really, it seemed like very mad about Intel lagging in the AI space. And I think recently they kind of maybe pushed off or stopped one of their AI GPUs for the data center market, Neil. Do you think that can change with this upcoming guy if he wants to focus more on the AI space?
No, so I think it was Falcon Shores that's not going to be released. That's going to be used for internal use only, and then the focus is on Jaguar after that. So I don't think that will change, and I think the fact that they announced it last quarter, I probably assume that the conversations with the new CEOs were already in motion. So I don't think that will change. And to be honest, maybe it might be better because now he has more time to make sure that Jaguar Short is much better than what they intended it to be. So yeah, focus on AI, but definitely also focus on what they're good at, because you don't want to basically destroy your cash cow, which is still the client side of things. So make sure that you're not losing more market share to an AMD, for example, and then try to get more market share, lost market share from AMD, from NVIDIA in the other segments. If it's going to work out, remains to be seen, but Intel is still a very, very large and an important company. And then you have the conversation around the foundry side of things, of course. What's going to happen with that? Spin-off, sold out, joint venture with TSM and some other players remains to be seen. But now with an actual CEO, you can start having those conversations with the government, with other companies, and that's why I think the market likes this, because now we can move forward. I think in 2025, everything will be quite clear. 18A, what's going on with Intel Foundry, joint venture, subsidiary, spin-off, what's going on there. All the restructurings, I think, would be over this year. All the impacts that from the layoffs, from maybe an IPO from their embedded side of things, from FPGA. So we'll see. We'll see what happens with that. But 2025 is a very, very crucial year for Intel.
Neil, I think I discussed with you outside of the stream about he did kind of share Intel's letter, a letter to his team, And it seems like from his letter, he's very bullish about kind of both the product design side and the foundry side. Do you think with that letter, do you think what are your, if you had to make a wild guess, do you think we're going to see Intel together, or do we see a split up in this year?
Well, as you know, I hope it stays together. Now we can have it stay together while also getting some strategic partnerships, strategic investment from outside players. And I think that's the best option. I think that would be the best option. I think that's even better than a CHIPS Act, for example. We've talked about that before. A CHIPS Act of 50 something $billion. Let's be honest, it's a lot of money, but it's not really a needle mover for the semiconductor industry. For an industry that should be worth trillions of dollars, $56 billion or so doesn't really do that much. And it's $8 billion for Intel, $8 billion of the $100 billion investment throughout the years. There is really not that much. So having strategic investment partnership with other players, well, let the private sector do their thing. It's usually much better than the government starting to play their part there as well. Although, of course, it is important to have an Intel that is successful. But yeah, I think we're going to see Intel, the client and the foundry side, still stay inside of Intel. Although I wouldn't be surprised if we have strategic partnerships with the TSM or some other players out there.
Definitely, Neil, I think we got a pretty cool question here from Rose about 4 minutes ago. And it's more like a investor mentality question. So if you still have 100% or 1,000% gain on your largest position after they fall 30% plus, and you think the stock will recover, do you buy more? Neil, I think this is, again, just like any other question, it depends. And first, I think the most important thing would be in my position sizing. If maybe, and everybody has their own different position. I think that's where it's all going to depend. Even with the 30% drop, is this still such a big position in my overall portfolio that I don't mind not adding more? But if it's like, and again, for example, NVIDIA is over 25% of my overall portfolio. Even with this drop, it's still over a quarter of my portfolio, and I don't feel the need to add more. Maybe I might add a little bit, but it will never be like a big position. But maybe if NVIDIA was like 10% of my portfolio only, I would say yes. If I believe, yes, but I think it's all dependent on the position sizing, and has that position sizing hit my max for that specific company. How about for you, Neil?
Yeah, I mean, it depends what's the reason. Why did it fall 30+%, right? If it's an overreaction by the market, was it too expensive? Did they miss? Or is the business itself deteriorating? Because if there's something wrong with the business, then yeah, 30% plus fall, even if you're still up a lot, you should reconsider maybe if the thesis is broken or not. Of course, if it's just one quarter, then I don't think we're seeing a thesis breaker, but it's always important to know why a stock falls. Now, if the business is still doing very well, but it's just an overreaction, maybe the stock was overextended, then yeah, depending on how much of the portfolio that specific stock company is, I'll add or I will not add. Like if it's the number one stock in my portfolio, I don't know if I'll rush to be buying more, for example. If it's number 5 or so, but it's already up that much, then yeah, maybe yes, maybe I will consider buying more. So it really depends on the scenarios, I would say.
Neil, I don't know if you have a question here that we can take. If not, I'm looking through some. I know I saw one earlier today, so I'll find one in a few minutes if you have one first.
No, but in the meantime, I can ask you, because you own Adobe. I know we talked a little bit about that off stream, but what are some of the things you will be looking out for during that summit? Because of course the stock did get hit. Lots of focus on AI, monetization of AI credits, and all of that. So, as a shareholder, what's on your 1, 2, 3 list that you want to see?
Yeah, so for me, luckily, while Adobe is in my portfolio, I think AI is one of those solutions here that's gonna increase its core products. And maybe that's where maybe the market is kind of creating some fear for Adobe that this should be a crazy revenue driver for the stock. But in forms of valuation, I think the market is just looking at this advancement the wrong way. And now that this company is not growing as quickly as they expected, we're kind of seeing the opposite reaction that AI is going to eat its moat, which again, I don't believe it's the case, but that is kind of why I find this very attractive right now. In terms of their summit that happens on Tuesday, I'm not too curious about credits for AI. I'm just more curious of what type of new AI solutions they're adding and if they're going in the right direction. I mean, we've seen a lot of I think in the past few days, we saw Google just release a new version of their AI model that focuses in image creation. So if you're seeing advancements from some of these players, and again, I don't think that if a company can create something with AI, you're going to lose the need for Adobe. Adobe is a full tool suite. It's not a just one thing type of thing. So first, are we also seeing those advancements from Adobe? I'm going to guess the answer is yes. Adobe has one of the biggest data sets here. And I think you mentioned it perfectly, Neil, with PayPal, where one of the things that you believe PayPal has that many people kind of forget about is kind of that huge data set. And with Adobe, I think that's the thing. It has a huge amount of data with how users are using its platform, with the type of imaging, the types of videos. And I think that's going to be a massive asset here for that company. So I'm just seeing the advancements. I want them to continue to advance in AI solutions, and that's pretty much all I care about. I don't want them to kind of hit any stalemate here. So if they introduce a new form of image model, a new form of video model, I think I would be very, very happy.
Okay, so if I understand correctly, by the way, yeah, the new Google AI Studio, I did play around a little bit with that. It's pretty good, pretty good. Some funny things you can do with that, but yeah, I would say then, I think Adobe right now, what you're saying is that you want them to make sure that they do not give an incentive to their current users to leave the platform and go to other solutions out there, like to make sure that whatever new AI imaging model comes out from a Google, from another player, video model, etc., all of that can be done and can be found inside of Adobe. So you don't have to leave our ecosystem. We offer all of it. It's already on the platform that you know how to use. Plus, if you need to edit anything, you can do this inside of Adobe. So I think that makes sense. I think that makes sense. And if that doesn't happen, then I think that should be a worry for investors.
Yep, definitely, Neil, and especially in the short term. But remember, in the long term, I think one of the powers with Adobe is it's not just about the image creation. Is a lot of these AI solutions right now, after it gets generated, they still need to be used. You still need to edit it in various ways, and as long as we don't, and I think that's also another important aspect of these are things that, while they seem kind of, one can cannibalize each other, you can kind of coexist with each other. So the great thing is, if Google announces some pretty cool AI solution for image generation, it would speed up the process. And then if you want to do more, it kind of pushes you to go into companies like Adobe. But yeah, I agree. I think Adobe, what they need to do is make sure that they don't lose out much or make sure that they show, hey, look, if you want to do cool AI stuff, just stay here with us in Adobe. Because I mean, I think their cloud platform is about maybe $40 or $50 a month. For a lot of these kind of AI subscription plays, is about $20 a month, and that's just for different styles. So if Adobe can do that, plus you get the editing, plus you get the all the other solutions, it still seems like a very attractive price, even with including AI solutions with it.
Yeah, and I think one of the most important parts here, of course, is video and images licensing, right? They've got the licensing, they've got the rights. So it's great that the other ones might have quicker solutions, or they've come out with a new model on a weekly basis. But if you want to use it commercially, I don't think you're allowed to do it. And Adobe does offer that solution. And I think for big companies, that's a big plus, not to have to worry about, can I legally use it or not? I think with Adobe, they make sure that you're getting licensed stuff.
Yeah, and for like you mentioned with that licensing for big enterprises, that's very important. If you're doing kind of a nice ad, this is what you're gonna make sure you don't need to worry about. Hey, because a lot of these AI companies go through various lawsuits, and there's still various kind of gray areas with AI imaging solutions, and AI generated solutions. But if Adobe says, hey, look, yes, all our images are based on our data sets, we don't have to worry about anything else. I think that's a major asset for the enterprise space.
No, I agree. Do you want to tackle that last question from Kim? Good show. Thank you very much. We appreciate that. What do you think about Synopsys versus Cadence? Because I know you probably follow these companies better than me.
Yeah, so yeah, to Kim, I want to say, while I do follow the semiconductor industry, these two players I don't follow to the extreme where I can make a distinction between the two. I think this is a market, though Synopsys and Cadence are both trading at valuations below their average. Normally, right, Kim, and I'm pretty sure you are familiar with both these companies. Both these companies focus more on the software space. And while they are impacted in the semiconductor industry, the great thing about them is they very rarely follow the cycle of the semiconductor industry, because no matter if consumers are not spending in electronics right now, the next generation of chip, the next generation of electronic board, the next generation of electronic component needs to be built out. So the research and development is always there. So these are why these two players tend to trade at high valuations. And right now, those stocks, in my opinion, have gotten beat up unfairly. They have strong free cash flow. Obviously, they kind of have that headwind with the Chinese market right now. But overall, I think there's massive tailwinds, especially as AI continues to innovate into things like Internet of Things. You're going to see more demands for more type of boards, more types of electronic components, of more types of chips. So I think we're going to see a nice tailwind for their licensing, for their testing, for their simulation products. And I think long term, if I had to pick, I don't know why, my gut usually tells me Synopsys, but I wouldn't mind kind of like a basket approach of, I do believe both these players are sitting at very, very attractive valuations, as there is a lot of tailwinds for those industries. But I do believe there are a few fools that follow this company, and they usually share kind of their research on them more deeply. So I definitely would recommend going to some of these boards and checking those two out.
All right. There was a question a day ago. Oh, actually, go ahead with the question that you wanted to answer.
I don't know if you wanted to take that one, Neil. It was based on Intel. And I wanted to see your thoughts. 2 days ago, randomly, kind of expecting Lee Bhutan to cut cost at Intel. Any thoughts at which parts of Intel's get trimmed or divested, Neil?
Yeah, so like I said, I won't be surprised if we have some more layoffs. Not great, of course, but if you want to cut costs, I think that's one of the ways. Mobileye is already a publicly traded company. They have, of course, a majority stake in that. Their FPGA segment is probably going to go public as well. So that's one way to raise more cash. Other than that, I don't see where the cost cuts are going to come, because the Ohio fab is already delayed up until 2030, 2031 or so. And I don't think they're going to slow down with the other ones. I think Arizona is very important, so they'll continue with that. 18A is important, and all the other products have to be on time. So cut costs, I think is going to be from maybe more layoffs, unfortunately, and then just raising cash just by making sure that there is a successful IPO.
And Neil, they had a plan that they had plans for a plant in Europe, I believe. Neil, is that one also delayed, or have you heard anything about that European plant?
Yeah, so there were a couple ones, but I think they're mostly delayed. I would say I think the most important one is in Ireland, and I think that's still up and running and doing very well. The rest, I don't remember. Is it Poland and Germany or maybe something like
think
that?
it was. I know Germany was one of the cases, and I mean, when I read it, I didn't think it was a big deal because I think they really focused more on like the advanced, on mature nodes. It wasn't for like advanced chips, and I think I like Intel really more focusing more right now on advanced chips opposed to mature nodes. Those will always be there, so they can kind of build those plants later on.
Yeah. So, and I think it's only going to happen if they get help from the government. So it's not something where it's going to hurt them at the bottom line. So if there's no help from governments outside, then they're just not going to do it at the moment. So there is that.
All right, Neil, this is both of us. We're both ending here, and we're gonna be followed up by Jeff and Rick. How's it going, gentlemen?
Hey, guys.
Hey, good day.
Hey, Rick, it's been a while.
Yeah, Neil, it's been about 60 minutes. So no, it's been more than that. Sorry, 2 hours.
Yeah.
Yes, it felt like an hour. So yes.
All right, guys, have fun.
All right, gentlemen,
Nice.
take care.
Thanks, guys.
Hey.
Hey, Rick, how are you?
I'm doing all right. I'm doing okay. I'm doing happy on a mid-March Saturday, day after Pi Day, and all that fun stuff. So
Yes, a lot of pie in my life yesterday as I walked around my day job. But yeah, happy to be here Saturday morning, Saturday afternoon, talking about recession resilient stocks. And if you guys have any questions, people watching, Slido.com, Fool24 is the code. Send them over to us. We'll answer anything you have about recession resistant stocks or anything else that you want to ask about. We'll do our best to answer those questions without giving any individualized advice, which we cannot do. So Rick, I think this is a fun topic to dive into for this hour. You know, it feels like at any point, if you follow the markets, you're going to hear people talking about recessions and there's predictions all over about like there's one coming soon or there's one inevitable. And I think a couple of years ago we were at a 100% chance of recession and it never happened. But you know, I typically don't make too many macro decisions in my day-to-day investing, but I do think it's worth thinking about what companies we have in our portfolios that might be at least resilient, if not resistant to downturns in the economy and recessions and things like that. So for fools watching, we got a couple in mind that we're happy to talk through, but we're interested to see what everyone else has to chime into this conversation as well. Rick, happy to start wherever you want. If you want to dive into one you're bringing to the table, or I can, or we can grab a question. Where do you want to kick things off?
Yeah, I mean, I guess there probably I know there are a lot of great questions, not necessarily recession resilient companies right now, but let's dive in. I'm seeing most of the stuff was from the last hour, so yeah, I don't mind diving in. One stock that I wanted to start with is an unusual stock, and you'll have to hear me out here. Yes, and John Gallegos is reminding me, Rick, don't forget about Roku. I told him 2 hours ago. He asked at the very end about Roku. So this stock is not Roku. So Roku is not on my list of recession resilient stocks. And the reason for that is because they are largely an advertising based model. Roku, obviously, viewership, the platform really took off the last time we had a recession, which lasted for just a couple months back in 2020. Technically, it was just a few months of recession in early 2020 during the pandemic shutdown. But Roku obviously took off then. But the one dynamic that wasn't really going to be working for Roku at that time was it's mostly an ad-driven model. The Roku, their hardware is practically given away. Sometimes it'll subsidize it, sometimes, but it's not really a high-margin product. Even when it does make a profit on the hardware, they just want you on their platform, and on that platform, you will be a free customer on the platform. But they want you to watch the ads, that they have revenue sharing, and they have their own ads or revenue sharing with some of the services. Or they want you to sign up for premium services through them, and they get a commission that way. And obviously, when money is tight, you're going to be spending more time watching, YouTube on your Roku or Roku channel, which is their free ad-supported channel, or some other economical service or something that you're already paying for than through Roku. So Roku did not make the cut in my recession resilient stocks, even though clearly it doesn't take the hit as hard as other platforms does. But my company, and again, it's Roku adjacent, and it is Netflix. And so Netflix is the kind of stock that immediately you think, well, hey, no, this doesn't seem like it's really a recession resistant company. But let me pull up. I'm not going to physically pull it up, but I wanted to go over the last few years. So basically, an interesting thing about Netflix is that it has never reported a decline in revenue. Never. Since a public company in 2002, already 22 plus years, never. The worst it's gotten was basically a 6-7% increase in 2022 and 2023. Every other year, it's been a double-digit increase. So even during, the dot-com bubble, we have 2021 data from it. So right around the time of 2020-21, it was growing mostly as a DVD service back then. Triple-digit growth then. Normal was just in its early days. But 2008, when that the great financial recession, the subprime lending crisis recession happened, it grew through that. An important thing about the stock. So obviously the business is resilient. And even though the price has gone from $7.99 a month for the streaming service to double that, $16 a month now, it's still able to grow. Revenue has actually accelerated over the past year. It's back to double-digit growth again. But specific to if you're saying, well, wait a minute, if I own the stock and the company's doing well, but the stock goes down, it doesn't really help me, and that's fair. And here's where I argue that in 2008, this was a bad year for the S&P 500. Again, this was the heart of the subprime lending crisis. Just 5% of the S&P 500 companies moved higher that year. Netflix rose 12%. They were actually the 12th or 13th best performing member of the 500 S&P 500, and it didn't do as well as Dollar Tree, Walmart, or AutoZone. Some of like the retailers that tend to do better when money's tight. But they did make big gains, and also most of the gains happened like in the first month or two of the year. So they basically just declined like a lot of other companies. They just had built up such early gains, but it did in fact beat the market then. It was actually the best. I forget it was 2003 and 2005, or maybe there were 2 years, like alternating years, that it was the best of the 500 S&P 500s. I don't have that on me, but you don't want great. I'm saying recession resistant stocks, and Netflix fits the bill. Obviously, I should make the disclaimer here, which in 2022, the S&P 500 did fall, almost 40%, and Netflix was cut in half. So it's not perfect. It's not foolproof. 2022 proved to be, the kryptonite for Netflix. But in Netflix's defense, since the end of 2022, that year that it lost half its value, it's more than tripled since then. So it's clearly more than made up for lost time. But with Netflix, it's every year that you think, now I'm pulling up just so I have them here. Just when you think it's going to be a bad year for the market, the revenue keeps growing. So in 2008, which is the great financial crisis, started around 2007, ended around 2009, but 2008 was the year that the market fell and the revenue was up there. Revenue was up 17%. In 2022, even when the stock did take a hit, revenue still rose 7%. So it's a company that still finds ways to grow its audience. And again, it makes sense, because if money's tight and for $16, that barely buys a single ticket to a movie theater, much less to your whole family or your date or whatever you want to do to movies. You can buy a whole month of access to the premier catalog, because Netflix networking effect, no one spends as much on their content as Netflix does, because they can afford to do it. They're dividing their costs by the largest base of any streaming service and the largest revenue generating of any streaming service. They can do it. You're not going to, that's probably the last service you give up, the last of the premium services you give up. So they always have that kind of retention tool when you need entertainment. And we know people spend hours at the end of the day streaming. We know that thanks to Roku, bringing Roku back in for you Gallegos. But so to me, it's Netflix is a stock that I think is recession resilient. Obviously, valuation wise, sometimes they'll get into trouble, which is what happened pretty much in 2022. But the stock is still delivering, still growth, and still an interesting company that has been able to buck the malaise of the economy year after year with growth.
Yeah, I love all the data you were able to put behind that, because I had a much more like just high level kind of view on, like a consumer view of it.
Yeah.
It's interesting that they did so well during like the Great Recession, for example, because I feel like they're so much more entrenched in American households now than they were even back then. And I think they were pretty entrenched at that point. To me, it feels like Netflix is almost table stakes for a lot of people now. It's just like, it's the thing you kind of have to have in your house if you want any sort of entertainment, and whether times are good or bad, people still want to go home and watch something on TV. Right. So, do I think that if we hit like a major recession, they would see some subscribers fall off? Sure. You'd probably see a lot of subscribers jump down from the the ad-free tier down to the paid the advertising tier. But actually, based on what they've been telling us the last couple quarters, that'd probably be better for Netflix as the business. I mean, I guess if advertising fell off, maybe not. But they seem to be driving people towards that ad tier anyway. Yeah, I love that as a recession resistant pick, because it's not that people don't spend during recessions, it's that they pull back on discretionary spending. And I'm curious how many people view something like Netflix as not discretionary. Their main source of entertainment at home.
Yeah, I always view it, again, this was years ago, and I haven't changed my mind now that there's a lot of great streaming services out there. It is basically basic cable for the new normal. It's when you cut your cord, you're saying, I'm getting rid of all this. But the whole live TV streaming market, Google TV, Hulu Plus, Live TV, Fubo, all these platforms that exist, they add up to maybe 20 million people. So it's just basically like 1/6 of the U.S. audience is actually, of the homes, less than a fifth of the U.S. homes are actually paying for a live TV streaming service. But Netflix, again, a lot cheaper, and it's just something that people just grew up with. And it's the kind of thing when a show is a hit on Netflix, everybody knows and everyone's talking about it. It's a pop cultural thing. Whereas, the others, obviously, everyone has their franchise, but Netflix, it seems like every week there's something, bubbling to the top that you sort of need to know, especially, at the water cooler at work or just amongst friends, to know, hey, are you watching this show? Are you watching the new season of The Night Agent? Are you watching Adolescent, this new show that's now #1 on the service? So all these things that are happening, it is a tastemaker, and you really can't. And for basically, again, $16 a month, that's less than 50 cents a day, which I know. Money is money, but it's something that you can say, well, if I'm going to entertain myself for a whole day and all I have to do is put 2 quarters in this Netflix jukebox, I'm going to do it. So yeah, I think it's well protected, but yeah, obviously it will take a hit in subscribers. But you'll find maybe other ways to come through it, but it should hold up better than most other companies that need the consumer, non-discretionary.
And just to go back to John's question about Roku, that's an interesting one to me. I would be curious to see how they do if we had like a serious recession, because there's the side of it that it's an advertising business straight up, right? That's the bulk of their revenue. So yes, when advertising spend decreases, you're going to see them take a hit. But the one thing they've been able to do for as long as I've been following the company, which is 4 or 5 years at this point, is grow active accounts, grow the amount of time people watch content on their platform. But average revenue per user has been the thing that struggled a little bit. And part of that's because they're expanding in markets where they can't monetize their customers as much.
Right.
But it would be interesting to see if they'd be able to keep the growth happening through a recession, because again, maybe people like to go home and just watch the Roku, right? After their stressful day at work where they might lose their job and they're depressed because of the recession. But it would be interesting to see just how much of an impact that pullback on advertising would have on that business, because advertising will pull back, but it won't go away. I don't think we're ever going to get to a period of time where we are blessed with not having to see ads. So I wouldn't put that one on my list, Rick, but I'd be interested to see how it does.
Yeah, same here. And so the original question was, John was asking him, how do you think, do you see big things for them over the next 3 to 5 years? Well, yeah, I do. I'm bullish on Roku. I know many of my fellow fools have sort of fallen out of love or out of like with Roku, not to get passionate about it. But to me, yeah, I think, and we saw this sort of happen with the pandemic, that while users picked up, and the time we spent streaming picked up, it was like 3.5 hours per day. Average Roku user was spending with that Roku remote. Now that we have everything available to us, every possibility of social activities, of actual movie theaters, actual social interactions, all these things, we're streaming more than 4 hours a day. So I think it's something that, usage will still go up, and it probably more so in a recession when you come home and you're worried and you don't want to go somewhere. The TV will be your source of salvation and entertainment. That'll be your that's your nightcap. That's sometimes your afternoon or your day cap. If you're between jobs or you work different hours or you work from home. But I do think that financially speaking, it will not be able to hold up as well as Netflix, because it is the kind of thing where, as you mentioned, ARPU, part of it is the fact that it's expanding outside. It's now #1 in Canada, #1 in Mexico, not just the largest platform in the US, and it's heading into other markets. But it is the fact that the advertisers aren't going to be spending top dollar to get a lead when money's tight, and they know that, why are we going to be advertising this or trying to push this out is a lot of content also gets delayed, as we saw during the pandemic. It happens during recessions too. That companies will hold off on a blockbuster, and that also goes for a streaming release when things are tight. So yeah, Roku is interesting, but again, it doesn't make the cut for me as a recession resilient company. But yeah, I'm a shareholder, and I don't mind holding it through the up and down markets.
Yeah, I agree with the take on it being recession proof or not. But I'm a shareholder too, and I'm actually, I think, with you on this. I'm more bullish than most folks around here because to me, as I've followed it for many years, like I said a minute ago, when the stock was falling and people were running away from it, I just kept looking at those three metrics that they report: active users, hours streamed, and average revenue per user. And every quarter they'd report those and they'd be up 10, 15%, whatever it was, 20% sometimes for streaming hours. And I just kept saying to myself, that's good.
Yeah.
That's what you're trying to do. And, I don't know how you feel about this, Rick, but I've been thinking a lot over the past year or so about these stocks where it's really difficult, I think, for investors, and myself included, to separate what happened to them during the pandemic from our brains, to give them like an objective look right now. Like, should Roku have ever traded for, I'm looking at my spreadsheet here, should it have ever traded
490 is, I think, was the high.
Yeah, like 30 times
yeah.
sales? No,
Yeah,
it should never been at 30 times sales.
Yeah.
But where is it now? Around 2-3 times sales? Like, that's not unreasonable. And they're becoming a much more efficient business. Like, one of the things that I track with this company is their operating expenses as a percentage of revenue. And 2 Decembers ago, it was 71%. Last December, it was 55%. This December, it's 46%. So they're working their way towards profitability and consistent cash generation and economies of scale and all that kind of stuff. So yeah, this is one I have more conviction, I think, than most people on, and I'm just hanging on to it, trying to see if they can complete the turnaround that I think has started. So interesting one to keep an eye on.
Yeah, definitely.
All right. Got a question also from John to me. I was looking at my Outset Medical position. I am down 95%. I also keep it on my spreadsheet so that I remember. Yeah, I was on earlier this morning, Rick, and I was saying how I was wrong, at least in how much I put into that stock early on. And I keep it in my portfolio. It's down 90-something% for me as well, just to kind of remind myself of that mistake of buying into the story before the results were there to back it up and putting a little bit too much in a little bit too early. I still think this company could be okay. I just think it's going to take a long time, much longer than I originally thought, to see if it will play out. And I don't know if it ever will. I could see it maybe being acquired at some point because it is pretty beaten down. I think they have a compelling technology. If anyone doesn't know, they make a mini fridge sized kidney dialysis machine that you can use in the home. You can use in an acute setting and a subacute setting, significantly less expensive than traditional dialysis treatments, considerably less time intensive, more convenient. But they're going up against a massively entrenched industry of dialysis that is not going to give up their market share very easily. So I think they've been struggling. But yeah, I don't know about if you do this, Rick. I like to keep stocks in my portfolio that teach me lessons. It's not a significant amount of money where, like, if I sold it, it would make a big difference. I believe it was less than $1,000 as I put into it years ago. So it just lives there as a reminder not to make that mistake twice.
Yeah, I'm not, but I learn all the lessons, even if they don't follow me in my portfolio.
Yeah.
Netflix in particular, I bought it in 2002, so I've owned it, and I sold 99% of my shares over the years, and it's terrible what my portfolio would have looked like if I just held on to that small stake. But Outset Medical, so Brian was, I think maybe it was John that had asked, or someone else, but Brian Orelli was talking about Outset. So I was just looking it up since I'm not very familiar with the company, and I see the quote and I see that's how much Netflix costs a day. 55 cents is what the stock is at now. So wrapping back to my Netflix comment about what a great deal it is for a share of Outset Medical every day, you can enjoy Netflix service at $16 a month. So yeah, it's rough. Yeah, my heart goes out. I don't mean to make light of the Outset situation because clearly they have a product that seems to be necessary and a disruptor and something that should be rewarded by the market. Again, I don't follow the company that well to know, but everything on paper sounds like it should have worked, but unfortunately, the stock chart says otherwise. So
Yeah,
yeah.
there were some mistakes. I think management, it was some self-inflicted wounds, so to speak, that they've worked their way through. And yeah, I've not given up hope. I love to see this one turn it around. It could take a decade, who knows? But it's one I will continue to watch. And those who follow my saga with this company will continue to come on Fool24 to bust my chops about, I'm sure. But yeah, all right, let's trying to. Nothing in the queue I want to grab right away. If there's one you do, that's cool. If not, I can bring one of my resistant stocks to the conversation here.
If you want, yeah, do that. I mean, there's a question I can address if you want me to address that first, or
yeah, go ahead, grab that, and I'll do mine next.
Yeah, so a question came in on waste management. Let me go back into Slido. Rick and Jeff, Stock Rob, thank you for joining us this afternoon. What do you think of waste management for recession-resistant stocks? So obviously, you get to services stocks, especially something like waste management. This is the kind of thing where, this is steady. It's not dynamic, and I'm pulling up the last few years of growth. But this is a company that's been, it's single-digit growth pretty consistently, except for 2021. A lot of companies, which was up 18%, but down 1.5% the year before. But really only 2 years of negative revenue growth over the last 15 years. So, and what it is, it's just 1.5% and 7% in 2015. Clearly a consistent producer, obviously a slow growth producer. So that 18% growth in 2021 offset by the 1.5 is a 2 year, bounces out to an 8% annualized over those 2 years. So you can safely say that this is a single digit, mid-single digit grower for most years, consistent, steady in good times and in bad. It's the kind of thing where no matter what happens, you need your trash picked up. The only side that I think waste management would sort of hurt would be if there was the only part that would be impacted by a recession would be if businesses closed down. So we go further back, revenue was down 12% in 2009. Now, I don't know if there was some kind of diversification. I know the company from the early days, from Wayne Huizenga, living in Florida. I don't know what happened back then, but it's just oddly enough that it loses 12% revenue the year following the great recession of that time. But again, and obviously consumer, residential, there's no, that has to keep happening. So I don't know so much about, that, but I agree with the fact that, waste pickup is something that, we go through waste, and that is timeless, which is why you see, like I was talking about the other, back in when I was looking at the Netflix stuff in 2008, the stocks that went up that managed up were Walmart, Dollar Tree was a big winner, AutoZone. And AutoZone, all auto part companies do really well in a downturn because, the O'Reillys, the AutoZones, all these companies, because you have your car and you're not going to buy a new car in a recession. You have to make it last longer. And if your car is getting more wear and tear and it gets older, you're going to need to maintain it. You're going to need to come in and get supplies to do stuff, change your oil. You're going to have to replace parts and stuff like that. So that's a very good environment that's a very industry, a retail specialty in the market that does well as far as recession resilient. But yeah, specifically to waste management, it seems like it would fit the bill. But again, not very exciting. Even when the time is good, it doesn't really bounce back that much either. But definitely seems like a steady performer financially. I don't know. I haven't checked the stock year for year, but it's slow but steady is what waste management is.
Yeah, that's not one I've paid close attention to, although I am compelled by the idea that we're all going to have things to throw out, and they're pretty well positioned in that space. It's just not something I've ever taken a look at. So I'm glad you could answer that question for Stock Rob. All right, Rick, the one of the other companies that we had on our list to talk today about for recession resistant stocks, one that I wanted to talk about is Costco. I've been talking about it a lot on Fool24 just because it's my newest addition to my portfolio. I bought a couple shares just to kind of keep an eye on it back in February. But there's some compelling data points, I think, that I want to just bring to the table. So I went back into Y charts and I just looked at how the stock did during the .com recession back in the early 2000s, and also the great financial crisis recession. And just using the period of time that Y chart sort of identifies as the recession, just some quick data points to kind of kick off this conversation. So going back to March of 01 to November of 01, which is when Y charts kind of identifies the recession period in that .com bust period, Costco's stock was down 2%. The S&P 500 was down 13%. Right. So that's data point number one in my mind. Like, we've already seen that's one recession. The stock has held up. I mean, it went down, but not nearly as much as the broad market. Doing the same thing for the '08 dip. So from January-ish of '08 to April of '09, this is ballpark. I didn't get the exact day. Same thing. Costco down 32%, the market down 40%. So just looking at like a shareholder perspective, like, how does this company hold up during tough times, share price wise, better than the overall market? And if you look at revenue growth, is just another indicator. Similar story in '07 to '08, it was up decently. Revenue was in that year. It dipped down again the next year, but then after that, just up and to the right slowly over time. So that's like the data view of Costco, but just from like a customer anecdotal data kind of view, when times are tough, people look for value. I think you're going to see next time there is a recession, I think you're going to see people really spend a lot more money at places like Walmart, where, places where things are perceived to be or really are less expensive. And I think Costco falls into that bucket. Yes, you're paying a membership fee. I could see some people viewing that as a reason to cut back. But I think if you're a regular Costco shopper and you're finding value in going there, if you're getting the 36 pack of paper towels, or you're buying pasta in bulk, or whatever the things you need in life, and you're getting them for a good deal there, that plus the loyalty aspect that kind of comes along with the membership, and people who have been members for a long time, I think really like the business and like going there. I could see that holding up just as well as it did in past recessions, if we see another one come up anytime soon. And I think the other kind of big difference is, at least around me, and I live in a pretty populated area in New Jersey, just thinking come back to 2008, 2007 recession period, and or certainly back to the 2001, there's a lot more Costco's in my area. So I think they might even hold up even better, because there's more people who might be closer to them. It might be an easier option to get to than some other stores. So that's one that I have on my list. Nothing is recession proof, I don't think, but I could see them holding up a lot better, and maybe even pulling some customers in when things are tight. People are watching what they spend and they're looking for value.
Yeah, and again, I mean, a year ago, I haven't checked lately, I think like 93% retention rate on their customers. So even though you're paying this fee, that went up by $5 back in October, people are still paying it because it's the fact that the company, I mean, they always say, hey, well, their net margin is almost 3%, and this revenue from the membership fees is 2%. So 2/3 of their profit is basically the memberships.
Yep.
They are not marking up their products, and you're buying it in bulk. So you're already getting a deal that it's already priced economically from their suppliers to them. And you walk into a Costco, you look up, you see the bare ceilings, you see the large, you are literally in a warehouse. They're not lying about this. This isn't Lowe's versus Home Depot. This is a situation where they're cutting every corner. And they're still taking care of their employees too, which is awesome for them and awesome for the employers, for the employees. But you still know that you can still get that $1.50 a hot dog soda combo, and more importantly, any product you buy, that hey, it's a fair price, and that will make you say when it's time to pay the bill. Just like when I was talking about Netflix, that I may as well just pay Netflix because it's a good deal. The same thing with a Costco membership. It going up $5 a year is not a deal breaker, especially when they had increased it, I think, for 7 years, maybe 8 years between increases. Definitely the kind of company that can, deserves paying an annual fee for. Especially with, even if you online, they also have great deals too. You can get like gift cards at a discount. I mean, I am a Costco member, but I'm not at the store as often as I am just buying, gift cards, discounted gift cards when I need something or a gift to give someone. Because there's a lot of stuff you can do as a Costco member that it's just, they take care of everybody. And I think that's, in a downturn. My only concern, and probably you may feel the same way, Jeff, even though I know obviously you just became a shareholder, valuation wise,
the stock, too expensive.
It's an expensive stock, but it's always expensive. It's never been like this cheap stock. But yeah, it's built for all terrain. It's an all terrain vehicle in your portfolio as far as being able to navigate the good and the bad times. But the stock's valuation is the only one thing that would say, well, wait a minute, if there's some kind of real recessionary market correction, not what we've seen this week, but even worse, Costco, it'll hold up better. It has a 5-year beta of 0.80. So it's basically, 4/5 the volatility of the S&P 500, though historically has beaten the S&P 500. I do think that it's the kind of thing where, the valuation is the only thing that would concern me with Costco. And Netflix is also, to bring back Netflix is also pretty expensive after tripling in the last 2 years and 2.5 months. But you pay a premium for the good stuff.
Yeah, I mean, I've said it on Fool24 a bunch of times. The reason I waited so long to buy Costco shares, it's been on my watch list probably longer than anything else, was simply the valuation. And then I got to a point where I said, you know what, I need to just get in. I need to have a couple shares. And I plan to add to it opportunistically over time. I mean, this is one I want a dollar cost average into for over the course of maybe years. And I know there will be times where it'll be a better valuation, maybe never cheap, but certainly better than with the 60-ish times earnings it's been trading for in the last couple months. The other thing I wanted to add on to the Costco conversation, I listened to the earnings call from their last report just a few weeks ago, and what's interesting, the conversation about that they had on the call after being asked by analysts about tariffs, I think is applicable to this conversation about a potential recession, because one of the things they said about tariffs is they have such a diversified network of vendors to buy from that they can really pivot pretty quickly from this brand of pasta sauce to this brand of pasta sauce if that second one is a little bit better deal for their customers. And they talked a lot about how they're going to really be careful how much of any increased costs they pass along to their members, right? They're really, like you said, they're trying to keep prices low. They're trying to prove that value. And I think that's an important thing just to think about. And then the other aspect that I think just helps them even more is they've been able to build their in-house brand, Kirkland Signature, to be a brand that people seek out, right? Like when I go to the grocery store, sometimes I buy the store brand just because it's cheaper, and I don't think I'm going to notice the difference in like the salt shaker if it's McCormick or if it's the store brand. But people go to Costco and like ignore the big consumer brands and seek out Kirkland Signature, right? So I think they have some brand power in their store brand that exceeds maybe some other retailers, and that's better for the business. That's better for shareholders. Those are going to be higher margin products that cost them less to make, and they can sell for even a better discount. So there's a lot of reasons I'm a fan, but I think a lot of reasons I am a fan are also the same reasons that will help this stock be recession resilient, at least.
So there is there's a question Fool's Quest asked. BJ's have been doing BJ's wholesale. This is BJS or BJ. I forget I think it's BJS, the ticker symbol. It's basically a wholesale club competitor of Costco. Do they have the potential to be the next Costco? I'll share my thoughts.
It's just BJ. Just
BJ.
so everyone knows.
Perfect. Yep. Yeah. All right. Clearly they're much smaller. They only have a presence in about like half the states, less than half the states right now. I think it's 200 some stores versus Costco that is up to 800 plus globally, but they have almost 600, about 600 stores in the U.S. So clearly a much larger concept. But yeah, BJ's does well. Sam's Club, obviously owned by Walmart, is another competitor, but again, not as large as Costco. And I think Costco has that skill that. But yeah, this has never been a winner take all. And again, if there's a BJ's near you and the Costco's a little further away, or in BJ's and Sam's Club, sometimes they have like really promotional deals like Groupon where you can practically get a year membership for like $20 or something like that. Go for it, hop on it, because the deals are great everywhere you go. I don't think BJ's has that same commitment to the low margin business as far as Costco goes, and volume wise. I've been to BJ's before. I lived when my wife and I got married. Oh wow, 30 plus years ago. We lived like 2 blocks from a BJ's, and it was never as full as the Costco. It's never has that long checkout line and stuff at Costco. And I haven't been to a BJ's in about 5 or 6 years. And it feels like it's a thriving business, but it's not quite Costco yet. And I think that I think that's the only thing. But again, if you can get a good price on the BJ stock, which it should be, especially with Costco trading at a premium, it's definitely an interesting way to play the warehouse club. But yeah, I expect Sam's Club, through Walmart and BJ's and Costco, if time goes tight, these companies are going to hold up better, I would think, than the rest of the market.
Yeah, agreed. And I was a BJ's member before I was a Costco member. We switched just because we liked the assortment of products at one versus the other. We liked Costco better. But yeah, I have plenty of people I know that are diehard BJ's members, and they love it just as much as I love Costco. So yeah, I don't think it's a winner take all. Rick, I want to grab a question from Sadaf from about 5 minutes ago, and I know this is one that you follow closely, but I think it ties right into our theme. How do you rate Disney in terms of recession resistance metrics? So I'll let you answer this mostly, but I'll give my thought real quick at the beginning here. I think they are not very recession resistant in terms of the parks and cruises and things like that. It is not cheap to go to any Disney property. So I would imagine when people do need to cut back, they're going to feel that. Now, I would imagine they might feel it less than some other entertainment destinations, because I do still think it's like top of the wish list for some people in terms of like a place to go. And, people will still travel during recessions, they just might not travel as much, but I can't see a world in which they wouldn't feel the pain a little bit. On the flip side, they have the streaming service, right? So that ties into all the things we were talking about earlier, that that competitive advantage that maybe Netflix has. I could see the streaming service holding up pretty well, because I do think for some households, especially ones with kids, they might view Disney Plus as just as essential, if not more than Netflix. So it does depend who's in your house, what they watch, but that's not, I don't feel like that's enough of a presence in the business overall to not have the overall company really feel the pain if there's a recession. But what do you think?
Yeah, 100%. Yeah, Disney is not recession resistant. And you're right. Yeah, the streaming service does give it an angle because of the brand. I mean, this is a company that when they launched Disney Plus in late 2019, I forget the exact number, but they had 50, 60, maybe even 70 million subscribers already on the platform from day one. They've just signed up. Everyone was really excited to see this happen. This was before we even knew that Mandalorian would blow up as a hit from day one on the platform. But again, they have the catalog. They have the Marvel, Star Wars, and Pixar beyond their own stuff, 20th Century acquisition. So they have access to a lot of content. But again, that's just one side of the business. And while you could say, well, Disney Plus, especially now that it's profitable, Disney turned profitable on their streaming business in the middle of the last fiscal year. You have to address everything else. Theme parks, as Jeff said, it's not cheap to go to a Disney theme park. And cruises, the cruises actually cost more for a Disney cruise than it would for like a Carnival, Royal Caribbean, or NCL cruise. And Disney is doubling their fleet. They have like 5 more ships. They just had a ship. I went on the new ship that they had last year on the Wish, and then they have now Treasure, I think, or Fantasy Treasure. Sorry, is a new one that just launched a couple months ago. They have another 4 or 5 ships coming. So this is a small fleet. It's become a big part of the business, and it's a premium price product. So it's the kind of thing where, especially with a family oriented thing, where most traditional cruise lines are fine with and when the off season, when kids are in school, they're fine because they can, they'll take care of the situation. Because a lot of elderly retirees, or just retirees in general, people that have the means to be able to travel off the school year, can go in and go on these cruises. Disney, not so much. So when the cruise that I went on in mid-September when I knew schools were in. So we not only got a great price on a new ship that was just basically a year new over Halloween, the first of the Halloween sailings back in mid-September, but the capacity, someone told me later on, yeah, the ship's only about 2/3 full, which is why we were upgraded to a cabin from the one we paid for. So, and yeah, so this is a business that really needs to have an economy humming along. Disney and the movies too. Again, while movies are great and that's escapism and it's something you think, well, that's a cheap, I'm entertainment. I'm going to go watch the next Marvel movie. I'm going to go watch, Lilo and Stitch when it comes out this summer, the live action thing. I'm going to watch the third Avatar movie when it comes out in December. Yeah, you probably will. But if money's tight, you'll say, I'll just wait for it to hit Disney Plus and 3-6 months later. And so, yeah, it is not a recession resistant company, but it's one that I think is dynamic enough that it's worth it, for me personally. But as far as recession resistant, no. Yeah, if there's especially with the global, this is a company that has theme parks all over the world, really. And while it only owns the Disneyland Paris park, has a significant but not a majority stake in the parks in Shanghai and in Hong Kong. And doesn't own Japan at all, the one Tokyo Disney, but it does get licensing revenue from Garden Oriental, which is a company that owns the park there. It is a company that is very international with as far as tourists coming in and with properties overseas. Yeah, if it's a kind of recession, especially a global recession, no, Disney will be challenged in that kind of environment. No doubt about it.
Yeah, and to be clear, like, if if I'm not a Disney shareholder, but if I were and I really believed in the business, I wouldn't let the potential of a recession keep me from buying it, because I think recessions happen. It's just part of having an economy. And we're talking a lot about recession resistant companies. It doesn't mean that's the only thing you should buy. I do think there's reasons to buy companies that you believe in for the long term that you think will suffer in a recession, because most of the economy does. So I don't think it's a reason to stay away necessarily. I think it's just something you have to sort of be aware of going into it, and also know why you bought it, know what you're looking for, know what metrics you're tracking, think about the future, so that when the inevitable recession hits, you don't get scared out of your shares, right? Because that's the hard part about a company like Disney that might see some tough times. It could make you say, all right, I made the wrong decision here, and that's short-sighted and could end up cutting future gains. All right, we had a follow-up question from Ed about Costco 5 minutes ago. Costco lost almost 15% for a recession-proof stock for those that bought at the highs. So two things, Ed. I don't think either of us were saying it's recession-proof. I think we were just saying it will hold up. We think it'll hold up a little bit better than the market overall, and maybe some other retailers should we hit a recession. And in terms of it losing almost 15%, and for those who bought at the highs, I'm pretty sure I timed the high. I just went back and looked, like I might have bought on the day it hit its last high. So I feel
for now, the high for now. Yes. Let's be hopeful. Yes.
But this is exactly the point I've been making over and over again about why I bought it when I did. I knew I was buying it at a high valuation. It's why I bought a few shares and didn't make it 6% of my portfolio, right? Like I know there will be better buying opportunities down the road. Do I think it is 15% less good of a business now than it was the middle of February? No. Do I think it was probably 15% too expensive in the middle of February? Yes. And that's how I look at it. It's not that it's less of a business. It's that it was probably just too expensive over the last several months.
Sure. I love the question that just came in.
Like you read our mind.
Yeah. So T Stock says, how about REITs like O is Realty Income? And that was actually the third stock that we were going to talk about today.
Yeah, let's dive in.
Questions. So Realty Income. Yeah, obviously, this is a stock. It's a real estate income trust, basically commercial property, about 80% retail. And right away you think, well, that's not, that's tricky. But it's what they're known for is they're one of the dividends. They pay their monthly dividends, but it's not just that they pay dividends monthly versus quarterly. You just get a third of the check that you would a quarterly dividend. That's not much of a, you're not basically hanging out for these monthly checks from Realty Income. But the yield is about 5.7%. So definitely competitive, more than competitive than short-term, safer short-term fixed income vehicles that are out now. But the company with Realty Income, the heart of it is that it's their consistency. They've paid a dividend for 657 months in a row. That's a long time, basically since it went public in 1994. Is if you stretch it, you want to calculate it down to years, and they've managed to increase their dividend 130 times. The last time happened 3 days ago. And again, when they increase their dividend, this isn't like a sizable dividend. It's like hundredths of a penny, sometimes thousands of a penny. So it's a very small thing. But the fact that this has happened over time, as opposed to cutting the dividend, is the kind of thing that makes you feel like, hey, I feel safe in this stock. The stock is going to go up and down. That is not going to be a thing. But at least so far through the first, 30 plus years of 31 years of existence. This is a stock. It's publicly traded. The dividend has kept going up every single time. That not every single time, but on a consistent basis without cuts. So this is why I think, again, there are a lot of quality REITs out there, but the reason that I wanted to single out Realty Income here is because of its concentration. It is basically built around as a triple lease real estate income trust. They basically buy building. In this case, about 80% of the business is retail. So and then they lease it back to the person buying, and then who's ever buying it takes the care of obviously pays the rent, pays the maintenance, pays insurance, pays taxes. They cover all the costs.
Everything.
Everything. So you're basically it's the steadiest thing. Except for the fact you're obviously betting on the health of the business to be able to make these payments, but you're not the one that's Realty Income itself is not going to be on the hook for anything. Like if there's wild here in Florida, we saw property rates go ballistic after these last couple of hurricanes a year or two ago. You're not seeing that with Realty Income. It's just their tenants are the ones facing that, which obviously can hurt them. But this is their concentration. 10% of their portfolio, their largest concentration, is in convenience stores. Another 10% in grocery stores, 6% in dollar stores. And this is, you remember I mentioned Dollar Tree was one of the big winners, back in 2008. And then you get to a lot of other categories like home improvement, restaurant, drug stores, and stuff like that. But 7-Eleven is their largest diversification. They have like 3.5% diversification. 3.5% of their portfolio is in 7-Eleven. So even their largest position is not that concentrated.
Right.
3% is also in Dollar Tree, 3.3%, and Walgreens. And Walgreens, as we know, is in the process of getting bought out. And you may think, well, that's bad because it's going to mean that they may close stores. Yeah, they might. But again, going private in the case of Walgreens, Boots Alliance, you are going to get a company that at least is the person taking over is going to do a better job of making sure they pay the bills. And again, Walgreens and CVS are two of the best performing stocks this year, as far as the S&P 500. So it's not a bad collection of properties. But again, the dividend is consistent. And these are properties, if you were going to buy into these individual businesses, you may say, well, yeah, why wouldn't I buy into like a grocery store business if it was attractively priced, or a convenience store where just by definition, they're there to give you gas, they're there to give you, quick snacks or something you may need, a little hot dog on the way to go. They exist for that. And that's the core of their largest concentration. So it's a relatively healthy concentration of customers. Probably a good reason why they've been able to increase their dividend 130 times in the last 31 years. And definitely a very consistent company as far as operations and performance. Jeff, I don't know if you have any thoughts on Realty Income.
No, you hit a lot of the big points. I had the same information up in front of me just to point out, and they actually call this out themselves. If you flip through their investor deck, anytime they do earnings, they point out specifically, and they show you with charts and graphs, they say out loud many times, our portfolio is recession resilient. That's a selling point the company uses on its slide decks. Now, that's their job, right? They're supposed to spin it in a positive way, but it makes sense to, I think, both of us. Yes, I do think when things hit the fan, so to speak, people will probably still go to places like 7-Elevens and Dollar Generals and Walgreens and Dollar Tree and things like that. And I like the fact that they're diversified to the point where, like you said, let's just say Walgreens specifically did close some stores. Even if they closed all their stores, that's 3% of the portfolio, right? That's not gonna really crush the business in any way. So they have good exposure in, I think, industries or sectors of the retail space that are resilient to things like recession, but they're spread out very well with the specific brands, right? So if any one company does start to struggle, it's not going to really have a material impact, and they can kind of pivot and bring in, clients in other areas that will take those spaces and things like that. So, and I mean, right now, I was just looking while you were talking there, the dividend yield right now is 5.6%. I mean, that's a pretty good yield, because the stock has been, down over the past 3 years. It's down 13%. So, the upside of that stock being down is that you get a decent yield. And if you bought today, and those shares you buy today are locked into that yield forever, right? So even if the stock recovers and the yield comes down, that buying a company like this when it's when the stock has struggled can turn out to be a benefit down the road in terms of dividends and things like that. So yeah, I'm glad that T Stock asked about this, because we had this on our list to talk about for sure.
Yeah, and so as far as Realty, the only year, 1994, the year that went public, had a 0.3% decrease in revenue. I mean, who knows what the company was doing back then in its formative years. The only year that it's ever had negative revenue growth was in 2009, again, coming out of the Great Recession, down 0.7%. And again, some of the growth isn't organic. I mean, they've always, they've acquired stuff. They now have a presence in the UK and in Europe, not a large amount. I mean, it's still basically a U.S. company, but they do have some more global diversification. But a company that delivers. And what Jeff pointed out is also important, because you're thinking, well, recession resistant? I want the stock not to fall during the recession. I don't care about revenue. The stock declined last year and down for the last 3 years. But this happened. The stock was up, and then most of the decline happened right around, the fall, right when the Fed sort of said, "Okay, wait a minute, maybe these rate cuts may not happen as quickly as we thought." and then you saw the stock sort of started to fade. So this is the one thing that obviously with a lot of REITs is, if income rates, if interest rates go up, which even if they have a variable, a percentage where they're actually getting more money from their tenants, if interest rates go up, it does affect the viability of their businesses and their own ability to finance projects. So that is a thing. But again, if we are in a recessionary climate, there's a pretty fair chance that the Fed is not going to be raising rates unless it's a stagflation environment. In that case, that's a lot scarier. But under a recession, the economy's soft. The economy, the Fed is going to want to probably lower rates to make the economy more balanced. And in that process, all of a sudden, a REIT at generating 5.7% yield is going to look a lot better than the bonds, so than short-term bonds or money markets that were yielding 5+% a year ago, and now are down to like 4.2%, where I have my money parked. So it is the kind of thing where, it benefits the company in a recession. They do benefit in other ways than just the actual core of their business is doing well.
Yeah, I mean, we're probably not going to get back. I shouldn't say ever, but I don't see any scenario, barring a massive financial calamity, that we get down to near zero interest rates. But yeah, I mean, they're lower than they were, and they could continue to go down. And so yeah, locking in a 5.5 dividend yield with a solid company like Realty, is definitely worth considering. All right, got about 10 minutes left here, Rick. I see one I can grab. Is there anything you want to hit on before we?
I have one, but you go first, and I'll grab mine if it's not the same question. So yeah, go for it.
All right, I was gonna grab this one from Ed from 20 minutes ago. What % of your portfolio is safety or value stocks versus growth and aggressive stocks? So I have to be honest. I might be unique in this, but so much of my invested wealth is in index funds and ETFs that I don't think that carefully about like what type of stocks I own. I tend to just gravitate towards businesses I'm attracted to that do things in the world I want, that I think are good, that I think have competitive advantages. Like I'm just kind of looking, regardless of if it's a swing for the fences kind of a stock or a stalwart kind of a stock, I'm looking for kind of the same things. If I do go the value/safety route, I'm usually just looking mostly for something that'll give me some dividend income. It's one of the reasons I'm attracted to Realty Income, for example. But I actually am starting to be a little bit more aggressive in how I think about my stock portfolio, because it is only 13-14% ish of my total invested money. I feel like I should probably take a few more aggressive swings here with this smaller amount of my overall portfolio, because I'm so diversified in index funds and things like that. But I think if I were like a 100% stock investor and that was all I had, I would probably want like a barbell approach, right? I'd probably want some of my portfolio in what I view as like safe, reliable Costco's kind of stocks. And I'd probably have a smaller proportion that was kind of swing for the fences, maybe binary outcome, some of the rule breaker stocks that I know you know so well, Rick. Just so I have like a little bit of both sides of it. What about you? Do you have do you know off the top of your head like what % kind of you are in each of those categories?
Yeah, as far as my stock portfolio, I sort of went the other way. I come from the rule breakers family. I've been with the Fools for 30 years, so I've always been a David Gardner style investor. Disruptive stocks. I don't mind overpaying. I'm investing for tomorrow, not for today or for yesterday. So maybe like I'll say like about 3 years ago, I was probably about 80% aggressive and 20%, if you want to put them in value, safety stocks in that camp. Now it's probably more like maybe 50-50. Right now, let's just say 60-40. I don't want to go completely 50-50, but it's about 55 to 45. 55 aggressive, 45 of value, and that mostly happened. It's not just by I had some epiphany. And I said, "Oh no, growth investing is bad. Growth investing is awesome," and I will always vouch that that's the way to go, especially when you're younger and you have everything in front of you. In my case, my wife, we worked the numbers, and a year and a half ago, she was able to retire early. So we said, all right, well, okay. Now that it's just, and she's still doing work side stuff, but, as 30 plus years as an educator, as an English teacher at a high school, at her alma mater of all places, we said, all right, we can do this. Let's go do it. Let's enjoy life a little more. And at that point I said, well, you know what? I think I'd rather be, de-riskify, if that's even a word, my portfolio to the point where I have a bigger nest egg. And at that point, it was perfect 2-3 years ago, because that was when all the money markets were basically going up. So I had a lot of cash on my portfolio. But I was talking only about my stock side specific. When it came time to put some of that money to work, about the last year, for the last year's interest rates have gone down on the short term. So the money market that I was getting 5.3, 5.4% at the peak is now at 4.2%. As that started coming down, I'm saying, well, I got to find alternatives. So I did go. So this is like Realty Income, a stock that I would have probably never really owned. Rick Menard circa 2021 would have probably never owned Realty Income, but here I am, and it's a significant holding in my portfolio. So I Costco is also one. I'm not as new as Jeff, but Costco, I didn't even own Costco until about 3 or 4 years ago. And again, I view that also while it is a growth company, it is a slow growth company. To me, I value it more as a safety, kind of recession resistant, resilient kind of company. So so I've sort of shifted away, but I've not forgotten growth. That is the way I invest. That's when I look for new ideas. That's what gets me the most excited. As exciting as it is for me to find a stock that's, hey, it pays a dividend, which is something I would never say 4, 5, 6, much less 10, 20, 30 years ago as an investor. Now it's a little more appealing to me because, hey, that's money coming in that I could use to spend on investing other things or pay for stuff in the future. It is the kind of thing where I'm not as aggressively the aggressive growth investor I was as far as a percentage of my portfolio. But when I do with that part of my portfolio, I still swing for the fences like I always have. That part of me is never going to die. It's just more of a financial planning sort of aspect why I'm not as aggressive as I was before with my total portfolio.
Yeah, I mean, that's something, I'm thinking the same thing. Every year that goes by, I start to think to myself, like, do I need to reallocate? Do I need to be thinking about putting some more in cash or bonds or things like that, safer assets? And it's one of the, if I could go back and yell at my younger self in my early 20s before I really paid attention to any of this stuff, I wish I had found like rule breakers, for example, back then, because that would have been the time for me to be risk on, right? With this huge time horizon. And, I love the fact that you don't want to bail on being a growth investor, but the reality is, like, so much of growth investing is, I think this company will be great in 5 years, but also in 20 and also in 30 and also in 40 years. And, you get to a point where you start to look and you're like, well, I need that cash in 20 or 30 years. It's not like I'm 22 and I can wait, half a century before I need it. So yeah, I totally get where you're coming from with that. All right, as we wrap up here, Rick, I don't know if there's another question you want to grab, or if you want to. I have a couple like thought-provoking questions about recession resilient stocks, but I want to give you a chance to grab something from the queue if there's anything that you.
There's a Johnson & Johnson question, but I don't really follow it enough. I'd rather leave it there for the next person. But ask away. I want to hear where you're coming from, Jeff.
Well, no, because this is so. I think a theme that comes through on Fool24 a lot is, people want to know like what to do because of this thing that might happen, right? It's like, what do we do because there might be a recession, or what do we do because there might be tariffs, or what do we do because there's this policy or that policy or this administration or that administration? And we touched on it a little bit earlier, but I think the way I've been thinking about that, and it's tied to this idea of recession resistant stocks, is I think it's important to think of those things as possibilities and at least let that inform the way you invest. And maybe you do make some decisions around the edges that are informed by what you think might happen. But I don't ever try to let these macro things change who I am as an investor, right? Like you were just saying, like, you're a growth investor, and it doesn't seem like there's anything that will shake that out of you other than the fact that you have to start de-risking your portfolio as you approach retirement, right?
Yes.
And I think that's what got me thinking about this when you said that, because I think once any person kind of settles into the type of investor they are or want to be, I don't think I want to let any macro potential thing shake that out of me, even if I am sort of making smaller decisions to sort of mitigate against it, right? Maybe I'm being a little more patient when I buy. Maybe I'm dollar cost averaging a little more versus a little less if things look a little more uncertain, but not completely changing who I am as an investor. So I just wanted to see what your thoughts were on that.
Yeah. So again, I think obviously stuff when news happens, you're going to react to it. But again, like you, I'm a long-term investor. So when the whole thing, let's just take an example, just a personal portfolio. When the whole tariffs war started to heat up, even before, just right after the election. So it got tricky. At that time, Chinese stocks took a big hit, and I said, well, wait a minute. I mean, I'm not buying for the next 6 months or a year. So I said, and I had sort of cooled down, even on the rule breakers universe, we sort of pared back on Chinese stocks a couple years ago when the climate seemed like it was going to be a little, wonky. And as an investor, I'm saying, well, hey, to me, it makes sense. And I did focus on companies like Baidu, that are mostly China specific, that it's mostly, it's not an external. I also bought some Alibaba, which does a good fair amount outside of China, but it's still pretty much a Chinese e-commerce company. Qifu, that's QIFU, which is a financial services company. And the fact that all these three stocks are trading for like, in Qifu's case, like 7-8 times next year's earnings or this year's earnings at this point. And Baidu and Alibaba were at 10, 11, 12 time multiples on earnings. And that was very compelling to me. And I know that, do we trust the Chinese stocks? Do we know how bad the tariffs were? This is just the beginning. We don't know where this all will end. But I think at the end of the day, the world's second most populous nation is going to be okay. So to me, I made those decisions. And yeah, I make decisions. I can react to the situation. But at the end of the day, I'm thinking of, Rick 3, 5, 10 years from now. And that involves going for growth, especially if it's discounted for an event that's temporary rather than what I believe will not be permanent. So, yeah.
Yeah, I mean, that goes to like the whole idea of margin of safety, right? Those stocks at the right price become a lot more compelling because it reduces some of the risk when the price gets so cheap, right? And you can think of margin of safety in a couple different ways. Like length of time can be a margin of safety. How cheap the stock gets can be margin of safety. But I think in the case of Chinese stocks, it's probably both of those things, right? Like there's short-term pessimism in the markets because of all the uncertainty, but I like your point. Second most populous country in the world is probably going to be all right. This is a 20, 30, 40 year game if you're playing the long term. So we are at the top of the hour, Rick. Here we got Asit and Brian coming in. This was great. Really enjoyed our time here, Rick. Hope you have a good rest of your day. Asit, Brian, welcome.
Valuation time.
Thanks a lot, guys. Good to see you.
Jen, have a good hour.
Thanks.
Hey, Asit, how's it going?
Hey, good, Brian. How are you doing?
Good. Got my 6-mile walk in today and feeling
Nice. I feel inspired in one sense. When you and I were doing a lot of time together during the pandemic on what was then Fool Live, you were running at that point. That was not the only thing, but it was one of the things that motivated me to start trail walking and doing a little bit of running. And I've kept it up to this day. So here's my chance to say, if you do nothing else, that you feel like you didn't contribute anything to society, which is, of course, for Brian, this is just being like facetious, but know that you influenced me in a positive way. I'm going to hit the trails probably later today.
That's good. Glad.
Awesome. And so we're going to talk valuation today. Obviously, Brian has such a great healthcare and pharmaceuticals bent, and I am more focused these days on tech and consumer goods, but we'd love to talk valuation in general. And I see some questions that were left over from the last hour. Brian, I was curious, could we start by getting some general thoughts from you on how you approach valuation, let's say in the pharmaceutical to biopharmaceutical spectrum of the healthcare industry, as we get towards maybe stable and solid cash flows, all the way to binary outcomes that we're not sure where like the coin will land. We have a sense, but we're not sure. I'm just curious, like, how do you think in terms of valuation when you're looking in this industry?
Yeah, I mean, so if the company has drugs on the market, then it becomes more of a price to sales ratio. Price to earnings can be difficult with pharmaceutical companies because they tend to have a lot of one-time payments that have to do with their partnerships and if they have a milestone payment that they have to pay out. So if you look at a PE, it's going to be sort of all over the place. And maybe you take maybe if you take the average of the last 4 quarters, it's a little bit cleaner, but it still tends to be pretty challenging. And fortunately, with drugs, for the most part, the gross margins are about the same, and the cost of sales are about the same. So really, like, price of sales it can be a good indicator of your ability to value the company rather than using GAAP earnings, which can be challenging. And then free cash flow can be useful. And so then you have to figure out how quickly the company is growing. And, so obviously, how much the revenue was growing year over year. And then you've got to also factor in, what's what do they expect to be growing next year? And then how much patents are going to come off of, how many drugs are going to come off of a patent? Obviously next year is important, but so is the year after that, and a little bit, and a little bit less the year after that, right? So it becomes challenging. Fortunately, almost all pharmaceutical companies that I can think of give a yearly guidance. So, and they tend to hit them fairly accurately, unless there's some major issue. So they're usually pretty good, and maybe more likely to be raising guidance than lowering it. So I think that's a good good indicator for what the growth is, at least for the next year. Figuring out the year after that and the year after that can be a little more challenging. You got to kind of do some back of the envelope math to figure it out. And then so then it's just like a slow growing pharmaceutical company is like one that, I mean, sort of a decent growing pharmaceutical company is one that's growing at 8 to 12% a year. Like that would be like, okay, that's you're getting paid for a solid dividend, and you're getting some growth, top line growth, and it's going to fall to the bottom line. And so if the price to earnings or price to sales or price to free cash flow, whatever you want to use, if that's stable, then the price should go up by the amount that they can grow revenue, right? And so if it's 8% and you're getting a 2% dividend yield, so now you're expecting like a 10% return for that company. And so
it's a little more formulaic.
Yeah, and so
that's
and that's so that's I think that's a reasonable for the risk that you're taking, right? It's not gonna be the 12% maybe that people shoot for if they're saying, well, I want to beat the S&P 500, and that's I think of 12% as being sort of like an ideal. If you can't get 12%, then what's the point? But the point is, if you're not taking on that risk, and you're maybe going to get 10%. Regardless, your return on investment on your your return is going to be around 10% every year versus being 15% and 5% and negative 2% and 20 something percent, right? Which is what you'd expect for the market in general. But for a large pharmaceutical company, I think your growth is likely to be more steady, easy going. So that's the way I think about it. And then you end up with these. I mean, so that's like the base case. But then you've got something like Eli Lilly that's growing at 40% per year, and a price to sales ratio of, like, let's say 5 to 8 would be a good price to sales ratio for a company growing revenue at 8 to 10%. But Eli Lilly's at 40% growth, and they're going to drop down to 32%, I guess, for like the middle of their guidance is 32% for 2025 compared to 2024, and their price to sales ratio is like 16. So now it becomes a little more challenging because it's sort of an outlier, and you don't really know, like, if it could grow at 32% for multiple years, then I think a 16 is probably not unreasonable. A price to sales ratio of 16. But if it's going to drop to 20 from 32, then you would expect that the price to sales ratio is going to drop a little bit, and that's going to take a hit. The price is going to have to take a hit, and yes, sales are going to be going up, so that'll make up for some of the difference. But ultimately, you're probably not going to get the return that you would get if the price to sales ratio stays at 16 and you get 40% growth, right? Then obviously you'd expect that company would grow it, might grow the value might grow at 40% per year, or 32% if we're using 2025's numbers. So
well, this is, and I want to actually for you to finish this, walking us through the spectrum, but I got some questions and observations here. I mean, first is we'll pay a little bit of a premium for the companies with those more stable cash flows in this industry because they're predictable, and that's worth something, right? You have maybe a little bit of more odds to beat the market, but then you do get an outlier like Lilly because of a new market potential, and then it becomes somewhat difficult to try to look past, I don't know, let's say 3 years, becomes very difficult because it's hard to know how the demand will last. Maybe, as time goes on for GLP-1 drugs, maybe there's some weird side effect that we don't know about yet because the data is so small. But the other two is,
I mean, I think the bigger issue is one, at some point patients are going to have tried it, didn't like it, and went off of it. Tried it, got to their goal weight, and went off of it. Right. So you're lowering your potential. I mean, yes, the market is huge, but you're lowering the potential of the market with every patient you treat. Right.
yes, that's true. But the thing, okay, as a someone who loves like a long-term cash flow that I wonder about, so I'm glad we had this hour together, is the propensity in like most like forms of this therapy now to have a cutoff point. If you stop taking it, then you're sort of going back to your baseline unless you've made some lifestyle changes. And for some people, lifestyle changes aren't going to do it. They have conditions that cause them to be obese. So you're lowering the potential market. But if I stop taking a GLP-1 drug, isn't it fair to say that I'm probably going to revert back to where I was before?
Right. And so there's going to be like maintenance doses, right? Which would be like,
maintenance.
rather than, so they're going to be getting the revenue, like maybe 1/3 or 1/4 of the revenue that they would have been getting while they were treating the patient to get to their goal weight. Right. So
got it. Yeah. So that maintenance dosage
there's probably going to be some people that yo-yo back and forth, right? That, stop taking it, and then they come back up and then they start taking it again. So I mean, there's the bigger issue beyond the fact that as you treat patients, it is essentially a cure, right? I mean, there's some drugs that aren't cures, right? I mean, I would say a majority of drugs are not cures, right? You take the drug, basically for the rest of your life. The disease, you're managing the symptoms of the disease, and maybe taking the drug results in you not having the symptoms of the disease. But then eventually, if you ever stop taking the drug, the symptoms would come back, right? It's not actually curing the disease. Where in theory, obesity, you're curing the disease, right? It's just that there's you have to do lifestyle changes to maintain that level, or you have to go on a smaller dose to not have that symptom, which is, I guess, in this case, symptom is weight, your weight gain. So I think the bigger problem is that there's competition coming, right? And so the other factor in those out years, 3 years, 4 years out, is that we don't know what the competition is going to look like, because those drugs that would be competing in out year, 3 years, 4 years out, are just now going into phase 3 clinical trials. So we have phase 2 data that suggests that they may be better than Eli Lilly's Zepbound. But we don't know that yet, because they haven't been tested in a large cohort like a phase 3 clinical trial would be. And of course they haven't been tested head to head. Although even by the time we get to by the time we have phase 3 data, they still have been tested head to head. But at least we can compare the large phase 3 clinical trial for Zepbound to the large phase 3 clinical trial for the drugs that are going into phase 3 right now. And there's a lot of oral medications coming on. So obviously, if you can have the same weight loss, same tolerability, and be an oral medication, that may be more preferable to patients compared to the same weight loss, same tolerability, but an injectable, even if it's only once a week.
Like Cagrosema, that's an oral medication? Just out of curiosity.
Is that Eli Lilly?
That's
Eli Lilly.
Novos.
Novo Nordisk does not have an oral medication on GLP-1 on the market right now.
Okay.
They're developing one. Eli Lilly's developing one.
Right.
Viking Therapeutics has one. I think Amgen might have one. I'm not sure about Pfizer's has a GLP-1, but I think it's injectable still.
Right.
Yeah,
I think Cagrosema might be the one that's in testing for Novo Nordisk. Okay. So this gets us to the question then, there's something analogous to like the tech world that I see. So just to continue this thought, in that window of like 3 to 5 years, these companies are building out a lot of capacity. So Eli Lilly is spending billions to increase its manufacturing capacity so it can tap the market as time goes on and sustain some type of healthy growth rate. You know, as you point out, it's not going to be 40% or even 30% plus forever. So it's very analogous to me to, well, like cloud hyperscalers, which are investing billions right now because they have a belief that that market for data centers and what they can provide in terms of like AI infrastructures is going to be significant down the road. And in both cases, you have people who have a better purview than anyone into the future. You have the CEOs of these corporations, and they're sort of placing bets that they'll be able to tap those markets. Not only the markets will be there, they'll be able to tap those and keep growing. And that's what makes this so interesting to me from the perspective of these large scale pharmaceuticals who you just described outside of this newer case, right? This sort of outlier case that this class of drugs has brought in a traditional time would simply be allocating its capital, some to shareholders, a little bit, you know, maybe stepping up R&D here and there, but it wouldn't be in sort of a growth investment mode, which makes it all very tricky for the armchair investor, especially one who's not well versed in the pharmaceutical market. So I wanted you to continue and just talk about sort of as we go from this, which has its own like nuances, to, you know, the smaller companies which maybe aren't working on widely or very pervasive diseases. They might be focused on specific diseases that have smaller populations that need treatment and are associated more with this risk profile of, you know, either the trials are going to show the efficacy and they can commercialize it, or they won't. And in this case, many of these companies are working on borrowed time. They're funded in the equity markets, and they have to commercialize before they run through their cash flow, and meaning because they're not generating cash flow in most cases, but whatever, well, maybe some from licensing agreements, but whatever they have on their balance sheet, let's put it that way.
Right.
How do you think about valuation in those terms?
Yeah.
for those
Okay. So
companies?
let me just before I answer that, I just want to go back to Cagrosema. So Cagrosema is the Novo Nordisk drug. It's a combination of cragylinitide and semaglutide, and so that's the Cagri part is an amylin, targets amylin, and the semaglutide is the GLP-1 that's already approved, and it is injected once weekly. So
Got
it's not an oral medication. That's the
Right.
one that read out on Monday. That was where the data was a little disappointing.
Right.
Okay.
Thanks for
So
clearing that up.
yeah.
I couldn't remember. But go ahead.
yeah, I couldn't. Yeah. I always forget that one because it's the name of the drug is actually the first part of two different drugs, right? So it's
Right.
a combination drug, and so I'd forgotten that. So when we're talking about a clinical stage company without any drugs on the market, right? That's sort of the valuation that you were looking for. I think that, the main thing is that you pointed out that they have a limited amount of cash, right? But they sort of don't, because they can always go to the market and do secondary offerings and get more cash, right? So they could always dilute shareholders and get more cash, right? No biotech that I know of has ever IPO'd and gotten a drug approved without doing multiple secondary offerings.
Right.
So that's pretty much the model, right? So now you're not necessarily looking for them to, it's not an infinite amount of cash, but it's also not a defined amount of cash. What it is a defined amount of cash for a certain amount of time, right? They have to get to the next value inflection point where they will then have a higher valuation, so that when they dilute shareholders, they will dilute them less. So let's say you've got a company that's at a $1 billion market cap. They have to raise $200 million for a phase 3 clinical trial. That's going to be a 20% dilution, right?
Okay.
But if they can get phase 2 clinical trial data that then gives them an extra, 500 million, maybe even doubles to $2 billion. Now raising 200 million only dilutes shareholders by 10%, right? So that allows them to, so you're looking at how much cash they have to get to the next inflection point, and ideally you want them to be able to get to 2 or 3 inflection points, because not every inflection point is going to result in value creation, because some of them the clinical trial might fail, and in others maybe the clinical trial is successful but the share price doesn't go up as much as you would have hoped, even though the data looks good, right? So if they can get to a couple of inflection points before they have to raise additional capital, then they're not going to dilute shareholders as much, and that's going to result in you having a larger piece of the pie. And so ultimately the way I think about this is that the terminal valuation, so let's say after they get their first drug approved, the valuation is going to be based on the market cap, right? It's not going to be based on the stock price. It's going to be based on the market cap. And it's going to be, and that's fixed. It doesn't matter how much secondary offerings they do, the market cap is going to be the same. So let's say, it's a $2 billion, let's say there's a $2 billion market opportunity, and we're going to assign a price to sales ratio of 8. That means it's going to be a $16 billion company. So every time they dilute shareholders, you're getting a smaller piece of that $16 billion. So if there were 16 billion shares, you would be, you would get $1. You would expect the valuation to be $1 per share. If there's, half of that, then you'd expect the valuation to be $2 per share. So, it doesn't matter. You have to think about the fact that, you'll see there's a couple of companies that have diluted shareholders substantially over their lifetime. And so if you plot the share price and the market cap, right? The market cap is sort of slowly going up to the right, and the share price is slowly going down to the right, because they keep selling additional shares, which then dilutes shareholders. So even though they're creating value in the company by making the company more valuable in its market cap, because there's more shares, the value of each share is less, because the market cap is defined as the market, the share price is defined as the market cap divided by the number of shares. So as they sell more shares, the value has to be less. So the investors are realizing that the company is valued more, but because there's so many shares out there, then the share price can't reach that high threshold, that get into the positive. So,
Brian, you're describing a venture capital investment, which makes so much sense. So if you're funding a company in the private markets and you're one of the investors in the first round, as that company starts to prove out its products and attracts more shareholders in subsequent rounds, you're going to get diluted, but you're focusing on how big that pie can get. Your portion is going to shrink, but if you've placed the right bet, then if it's a really, really big pie, you can still do pretty well. And so this is something that I had never thought of before, because I don't know this industry well, and it makes just a lot of sense as you explain this out. You should be prepared as an early biotech investor, one that's come public, for it. And it's going to raise capital. It either has the equity market or the debt market. And I think most of these companies, the equity market is a much easier route than trying to raise debt, unless it's maybe convertible debt. So you have to focus on market capitalization, which is the opposite of the way that we think in most industries, which is to keep the focus on your part of the pie, right? I want my per share earnings to grow. And if anything, I want the company to use its cash flow to buy back shares so that I get a bigger piece of those earnings. So this is sort of like an insight that you've unlocked for those who want to invest in this, to understand you're really focusing on what that market capitalization could be in a few years. So let me let you continue and wrap it up. I could pick your brain the whole hour. I know we have to get to questions. I'll let you wrap this up though. Keep going, and then we'll hit some questions.
Yeah, and so then it's mostly just, so for binary events, like let's say a clinical trial, it's literally just a math problem, right? I did this yesterday, so you can go. I showed a spreadsheet, and you can go this exact hour, the 3:00 hour. I was on the valuation show on Friday, so I showed a spreadsheet. I won't pull it up again. But basically, you can go back and look at it. But right in the beginning, first 15 minutes of the show. But basically, it's a math problem where you start off with the expected result, if the expected share price if the result is negative, times the amount of the likelihood you think that the negative event is going to happen, and then you add in the share price if you think it's going to, the share price you're expecting if it's positive, times the likelihood that you think it's going to be positive, right? So
Right.
let's say a simplistic situation, you think there's a 50-50 chance that the binary event's going to happen, and in one case the value is going to be 0, and in the other case the value is going to be 100. So then you would take 0 times 50% is 0, and 100 times 50% is 50. So the current value of those shares should be $50, and you're betting, you're basically betting a coin flip, right? I mean, it's the same as a coin flip, right? If I bet you $50, you want, I'm either going to take the $50 from you, or you're going to get $100, right? So that's so you could think of it as, if it's a 70-30, then the value in that case would be 70%, or that would be $70, right? If you think there's a 70% chance that it's going to go to 100, and there's a 30% chance it's going to go to 0, then the value should be 70. So coming up with the numbers for the potential values, if it's a success or a failure, are challenging but not impossible, right? You could use the cash on hand as your low price. You could use 0 as your low price, and then figuring out the high price. Most of the time, the easiest thing to do is find another company that's at the stage that it would be after this event, right? So find another company that has a $2 billion potential market, that has a phase 3 clinical has just had a phase 3 clinical success, and see what the valuation of that company is in terms of market cap, and then just change the market cap into the valuation from there. And then the harder one is trying to figure out, what percentage chance is it going to be to succeed, and what percentage chance is it going to be to fail. That's a little bit more challenging, and requires, looking at the phase 2 data and trying to figure out, what's the likelihood that we're going to replicate that data, and was the data good or better or best, right? And so that becomes, that's the science behind it. But then once you do that, it's just a math problem, and figuring that part out is not that challenging once you've figured out the hard part, which is the numbers game, and trying to figure out what the prices would be and what the likelihood of success is. And you can always, the nice thing about this is you can do multiple scenarios, right? You can say, okay, well, if I think that the price is going to go to this high, and I think that the likelihood of success is this, what should be the current valuation? And then I can do another scenario where, okay, well, maybe it's really, maybe the data is really good, so maybe it goes this high, but then, maybe that's not as likelihood. So we put a lower likelihood of success on it, and what's the valuation there? And then, you can play with those numbers. And then if you're buying below that theoretical risk adjusted price, then in theory, you're making a good investment, right? So, so that's the way I think about valuing clinical stage companies that don't have any products on the market.
That's wonderful. And that part is very intuitive to me, what you've just described. In manufacturing, we used to use this in industry to project like sales, the probability of what the salespeople were telling us. We'd assign the probabilities. The salespeople never, it's always 100% with them. I'm going to make quota. Here's what I've got. And you collect all that information from the different salespeople, throw it in a spreadsheet, assign probabilities based on who your closers are. And that's how we used to budget. So that part, just fits into place. And also what you just described was, somewhat similar to like a sensitivity analysis, which is you're thinking of the different assumptions and saying, okay, if this assumption is actually more correct, what does this look like? Or maybe if this case turns out to be the one, how should I adjust the math? I'm really interested in that. I want to use what I've learned today and apply it to some non-pharmaceutical companies and play around. All right, Brian, I promised I wouldn't keep you talking the whole hour, so I'm going to grab a question, give you a chance to take a break. But thank you very much for that overview. It's very informative, and I hope that helps members to get more comfortable with an industry I know many of us feel a little bit hesitant sometimes to invest in. I wanted to take a question from Sadaf, which is going to be the win the gold medal today, Sadaf. What is inventory for a software company like Synopsys? Now, Synopsys is a company that provides electronic design automation. So it provides software to help other companies design chips, to figure out the transistors on silicon, to make those amazing chipsets and GPUs, CPUs, etc. So it's a company that everyone thinks of as having a lot of intellectual property. And in fact, it sells its own IP off the shelf. You can buy pre-done chip designs from Synopsys when you're building your own chipsets. So I was working one morning, and this is about a year ago. I was just sitting here working at my computer, and I get a sort of urgent ping from none other than Tim White, who's a tech guru. He says, I'm on the morning show. Asit, why in the world would Synopsys have inventory? Guess what my answer was, Brian? My answer was, what the hell? Synopsys has inventory, and I thought I knew this company pretty well.
Yeah.
So this just goes to show you, and I'm a student of balance sheets myself. Somehow I glossed over this, but Synopsys does indeed sell hardware. The hardware is logical when you think about what the company does. So Sadaf, to really validate some of these designs, you actually need specialized hardware that helps you test the designs, especially when you get into certain types of chips like field programmable gate arrays. You need hardware to validate the design of those. And there's a lot of testing, special design testing hardware that Synopsys makes, and it carries a balance on its balance sheet. So to do the thing that so many of us have thought for the longest time is all like software magic and just selling intangible property, turns out if you're designing a chip, you have to know how it's going to function in the real world. You have to understand how it's going to tape out, and to use a term of art in the industry. So you have to test it along the way. You don't want to put a great design into production if you haven't validated it. And this is why it has hardware on its books and why it has inventory on its balance sheet. But yeah, I mean, this is such a great question. Many people who study this business I know couldn't explain that. I couldn't either. So I'm being perfectly frank here. But now I know, and now we all do as well. Brian, which question would you like to take next?
Ed asks, would you include Johnson & Johnson as a safe stock during recessionary periods? Yeah, so I wrote an article, I don't know, it's probably at least 5 or 8 years old now, where I just went through and I took the Johnson & Johnson stock price chart and I just found each one of the peaks and each one of the valleys, and I just looked at the price. And I put that price into my spreadsheet, and I put the S&P 500 price on that day, that closed on that date, into my spreadsheet, and then looked at it, and it beat, not surprisingly, it beat the S&P 500 on all the bottom, at the bottoms. It returned a higher return than the S&P 500 from all the bottoms, but it also returned a better than the S&P 500 from all the tops, except for I think maybe the last one. I think the last one, which was only a year, it was only a year prior or something. It hadn't beat the S&P 500, yet. But I just found that very, interesting. I mean, I just did it as an exercise and then ended up writing an article about it because I thought it was so crazy. And that you could probably find the article something like "There's never a bad time to buy Johnson & Johnson" or something like that is the headline. So that was before it lost its, sold off its, or spun out, I guess, its consumer health division. So it was probably a little more stable then because it had this slow growing consumer health business, so now it's only got medical devices and pharmaceutical company and pharmaceuticals, and so the data, so it's probably like a little bit more volatile, and I'm not sure that would be necessarily true all the way through. But I think it's big enough and that it should be, fairly uh, recession resistant. That doesn't mean it's not going to go down during the recession. In a bear market, it may go down just because valuations get compressed, but it should be able to continue to sell, and grow, maybe not as fast, but at least a little bit, and it'll continue to, pump those the revenue, the earnings back into the company in the form of R&D, and so that should result in more drugs and more medical devices in the long run. So I think it's a fairly stable company. I'm not, I wouldn't guarantee that it would go up in a recession. I don't think it, necessarily would, but it's certainly not. I think it's likely to go down less than the S&P 500 in a recession, bear market type situation.
So, Brian, I'm going to take a question that I'd love to hear your opinion on. This is from Matt, and the question is, Asit, the boxing of ResMed, symbol RMD, suggests to me that the stock advisor team doubts that both RMD, ResMed, and the various GLP-1 drugs can be winners over the long term. And I think by this, Matt means both at the same time. So ResMed is a medical device maker that is indeed on the stock advisor scorecard. When Matt refers to boxing, he's not talking about putting it in a gift box and presenting it to investors. He's talking about...
I thought he was putting it in a ring and just going at it.
Yeah. We liked the stock. We got it in the ring. We started pounding on it with our boxing gloves because we were so frustrated. No, yet a third box, which is the penalty box. We put this basically on a hold on our scorecard recently in a round of penalty box issues. The reason being that we want to pause and try to get some data over the next few quarters. And here's what's going on. So ResMed is a leading provider of CPAP machines. So CPAP stands for continuous positive airway pressure. These are machines that help people with OSA, obstructive sleep apnea, get a full night's rest. And for some, I know at least one person, a good friend of mine, who is on a CPAP machine at night because his wife said, I can't take your loud breathing and snoring and gasping for breath on the hour. So it also can give partners a good night's sleep. Just putting that in as a unpaid advertisement for the industry. Now, why would GLP-1 drugs be a threat to ResMed? In some ways, it's actually beneficial. In the short term, this is what ResMed is saying, that look, as more people are trying to seek treatment for obesity, sometimes because these go hand in hand, obstructive sleep apnea and obesity, sometimes we see, at least in early cohorts, patients coming out of the doctor's office with both a GLP-1 prescription and a path to buy a CPAP machine, hopefully from ResMed, because both are being diagnosed and both are being treated at the same time. But longer term, we don't know what the outcome is going to be, because these drugs are becoming so good at reducing obesity. And in some cases, this actually cures the obstructive sleep apnea. If you cure the obesity, not in all cases, but in many cases, that obstruction goes away. And so this could be net negative for ResMed over the longer term. And so we are not down on the industry. We're sort of enthusiastic about it. We've recommended McKesson, which is the largest pharmaceutical distributor in the United States, because we think it wins either way as more and more of these drugs hit the market. It's agnostic to who wins the race to dominate the GLP-1 drug market. We recently recommended Novo Nordisk as it has its own turnaround story and begins to try to compete with Eli Lilly and some other players in the market. But what Matt is asking is, hey, it sounds like you don't think both can be winners at the same time. And the true answer is, Matt, we're not sure. If we thought that, we would have just sold the company. And management, if you read the earnings calls transcripts, they're actually pretty positive, where they're communicating positivity. And they think that this will bring more people to the market. And potentially that will happen. So we're going to study this a bit more over the next couple of quarters. But I would love, while we're both together, to hear Brian's opinion, if he has one, on the fate of a company like ResMed. Last point, I didn't mention this before. I should say Zepbound, we were talking about earlier, I think is getting approved just for this treatment alone as a obstructive sleep apnea.
I think it's actually already been approved.
Been approved.
Yeah.
So this is part of our concern, and that's why we put it in the penalty box. Thoughts, Brian, if you have any?
Yeah, I mean, I think it's challenging, right? So yes, I think that people who are overweight are more likely to have sleep apnea, and people who lose weight can have their sleep apnea go away, right? So that would result in them not needing a CPAP machine. So I think that's basically your argument, right? Is that if people are losing weight on GLP-1s, then they're not going to need a CPAP. They're not going to have sleep apnea, and therefore not need a CPAP machine, and that's going to hurt ResMed. That's the hypothesis, right? And for putting them into the penalty box, right? So the question is, like, is that going to be the case, right? And I think there's a couple of issues, right? One is that these GLP-1 drugs have horrible tolerability. Like something like 50% of people are off of them in the first 6 months or something, because they have lots of gastrointestinal
and
issues.
side effects.
Yeah,
side effects.
Yeah, I mean, they make you nausea, make you feel nausea, maybe vomit, maybe have diarrhea or something like that. And so a lot of people, stop taking them simply for that reason. Now, maybe there's going to be second generation and third generation drugs that have higher tolerability, and, maybe they're, less, maybe you're only, I think a lot of times it's only the initial injection. So once a week, that means once a week you're feeling sick. But if it's once a month, then only once a month you're feeling sick. So, maybe, people are more likely to tolerate the once a month drugs compared to the once a week drugs, just because they're, they're having four times as less times that they're sick for a day or two. So I think that obviously ResMed's been doing quite well. I think that there's potential for it to slow down in growth for sure, because of the GLP-1 drugs. But then again, you've talked about it, like there's probably going to be people that are yo-yoing, and ResMed is not just like keeping people from having to deal with partners that are snoring. Like, this is like a serious problem. Sleep apnea is a serious problem, serious disease that lowers your life expectancy if you don't treat it. You're not going to die from it directly, right? You're not going to like die in your sleep. I don't think. Don't quote me on that, but I'm pretty sure the likelihood that you die if you have untreated sleep apnea, the chances of you dying in your sleep is pretty low. But the chances of you dying from diseases that are side effects of having sleep apnea, results in your heart having to work harder, and therefore you're more likely to have a heart attack or a stroke or something like that. So I think the patients that have sleep apnea tend to have shorter lifespans because of other diseases that are caused by the fact that they stop breathing in the middle of the night for a few seconds, and then they eventually catch their breath and start breathing again. So it's not like you just stop breathing and you die. You stop breathing, and then your body sends a signal to start breathing again, and then you start breathing again.
It's not great over the long term,
right? Which is not good. It's okay to happen every once in a while, but you don't want it happening multiple times a night for the rest of your life. That's going to result in some issues. So I think that's the major issue, is just how much are people going to lose weight, and then the fact that Eli Lilly already has it approved for sleep apnea, and and I think that's just a trick to get insurers to pay for it, right? They're not actually like treating the underlying condition of sleep apnea. They're just treating the weight loss, and having weight loss results in less sleep apnea events. And so, but the insurers, where they might not pay for it just because you want to look better, they will pay for it because they realize that if they can if they can get you off of sleep apnea treatments like ResMeds, then they don't have to pay for it, the machine, and then they also don't have then they also don't have the issues that are caused by the sleep apnea events, and so that results in you having less. That it may cost them less money down the line, and so they're willing to pay for it now. It's the same thing with the Zepbound is also trying to get approved for osteoarthritis of the knee. And the reason for that is the same thing. Like you lose weight, now you're putting less pressure on your knee, and your knee is going to hurt less. And so they can actually measure. They're hoping that the clinical trial is supposed to read out this year, I think. But they're hoping that they're going to be able to prove that you get less pain in your knee because you take Zepbound, and it has nothing to do with treating the knee or the pain. It's literally just you're weighing less, and so therefore you're putting less pressure on that knee that already has the osteoarthritis, and then that causes you to have less pain. And so again, the insurers will pay for it because they know that if you have less pain, you're less likely to take other pain medication, you're less likely to have a surgery or something like that that's going to result in high payment. So they're willing to pay for it, where they're not willing to pay for it just to make you look good. So I think for ResMed, I think it was probably a good move to put it in the penalty box and take a wait and see attitude in terms of whether you should continue to own it or whether you should sell it. You're not saying sell right now. You're saying don't buy more, don't add to your position. And if you currently haven't bought it, even though it's a recommendation, we don't suggest you buy it at this valuation. We'd like to, see more about it. So I think that's a good wait and see attitude, and see where these GLP-1s lay out and how much, the average person actually ends up losing weight on these obesity drugs.
Right. Yeah, I appreciate that perspective. Okay, Brian, it's your turn. Sorry, I asked you for some input there, but it is your turn to take a question. So grab one that you want to answer, and then
so there's a question on Neurocrine. Let me. Brian Fan asks, what do you think of, or how do you think of Neurocrine Bio, the ticker is NBIX, valuation looks these days? So let's pull up the chart and do a valuation. It's coming. All right. Just waiting for, there we go. Okay, so here's the chart for Neurocrine Biosciences. The purple is the share price, the orange is the price to sales ratio, and the blue is the growth rate, year-over-year growth rate changing each quarter. So that's why it's so straight lines, is because you're going from one quarter to another quarter. So the growth rate was 21.8% in the fourth quarter of 2024. But then if we go to, we see that the valuation has dropped substantially, right? And it seems to have dropped. You could kind of guess this is probably the 2020 Q4 2024 earnings report that resulted in it dropping right here. So if we go to that Q4 2024 earnings report, we can see that they're expecting 2.5 to 2.6 billion in sales, and in 2020 for their main drug, which is Ingrezza, it treats tardiva this disease right here, which is basically like shaking. It's like shaking basically. And so it can be caused by a couple of different diseases, as well as some drug reactions and stuff like that. But it's, obviously it's a more than a blockbuster. We define a blockbuster as a $1 billion drug, and so it's at $2.3 billion. But if you do the math between 2.3 billion and if you look at the median here at 2.55 billion, that growth rate is only 10.8 or 10.9%. So it's going from 26% growth for the year and 23% year over year for the fourth quarter down to, less than 11% growth. So that's the reason for the decline here. And the reason for both the decline in the price and the decline in the price to sales ratio, because it's no longer, the growth rate is no longer going to be in this 20s to 30 to low 30s range. It's going to be down here, like not even on this chart at 11. The growth, this blue line is expected to go down here for the next 4 quarters on average, right? So I think that's obviously the reason why it's declined. Is are we catching a falling knife here, or is this the new valuation that is seems fair? Obviously, this was maybe a one-day change. I guess we could look at it on a year to date, and we could probably see whether that was a one-day change or multiple days. Yeah, so that's probably just a one-day change, right? So it dropped to here, and then now it's continued to drop another 10%. So I think that it's hard. These are ones that are hard to tell. Is it gonna level out here? Is it gonna return return to maybe this level because this is sort of an overreaction and we've gotten through all the selling right now, or is 4.8 price to sales ratio the new okay? I think 4.8 is, for a 10% grower, 4.8 is on the low side, but not horrible. And then of course they do have a new drug, this chronicity, that is a treatment for adrenal hyperplasia. I don't know that this is a multi-billion-dollar market, but and I don't know how much competition they have there. But it's early launch, so there's potential for maybe some growth there. And then they do have a phase 3 clinical trial running out in major depressive disorder. Definitely a large market, although you're competing with a lot of generics in major depressive disorder, but a lot of patients don't respond to the generics, so there's still quite a market for that. And then they've also got a schizophrenia drug that's initiating the first half of 2025, but so that one's a ways away. But this one potentially could be on the market at the end of 2026. So but I don't like investing in depression because it's so dependent on the ability of the of how the patient reacts, right? So when you have a tumor, you're looking at the size of the tumor to whether the patient responded to a drug. When you're looking at depression, you're just asking the patient, how do they feel, right? So a lot of times the placebo effect is much greater in something where you're asking a patient how they feel versus where the placebo response is for a tumor is literally just okay, maybe a tumor dies off for some random reason. It's probably not due to the placebo at all, right? We're just counting that as the control group. What normally happens, if we don't treat it at all. Where in this case, it's literally we're measuring what happens if we tell a patient that we're giving them a drug, even though we don't. And so, oftentimes, clinical trials will look good on a phase 2 clinical trial because they because the patients don't know whether the drug works or not, right? And then they go and run the phase 3 clinical trial, and in the especially now with Google being so readily available, all the patients are going to go Google the drug and see what happened in the they're going to see the headlines of the phase 2 clinical trial and see that it was successful. And so all the patients that get placebo in the phase 3 are typically going to perform better than the patients that got placebo in the phase 2. And then, so even if the drug works, and the drug works as well in phase 2 as in phase 3, if the placebo goes up too high, now the difference between the drug and the placebo may not be great enough to show statistical significance. And so that's the reason why I don't invest in depression drugs until
so
they're
funny.
already I'll invest in them after they've been approved, or even after they have solid phase 3 data. But I refuse to invest in companies that have phase 3 data coming up, because in depression, or something like pain is another one that's really challenging to deal with. And so, I put it in the too hard to. I don't know how to. We were talking back at the beginning. We had that number where we gotta, what's the percent likelihood of success and what's the percent likelihood of a failure, right? So on that phase 3, I don't know how to put what numbers to put into that calculation, because I don't know what the placebo is going to look like. The placebo could be the same, and in which case, we should have the likelihood of success in the 80 or 90% range. But likely, placebo is going to go up. But does that mean I should put it at a 70%, or should I put it at 50-50, or a 60-40 against? I just don't know. So I put them in the too hard to invest in pile.
This reminds me of Vertex Pharmaceuticals. Has a non-opioid pain inhibitor. It was the candidate was VX-548. I forget. They actually have now a drug that's been approved as of just a few weeks ago, and I forget the name of it. But this was very hard to follow, because you're rating the efficacy of the drug on a subjective scale. So you're reporting back to the physician, I feel less pain, I feel more pain, because all the pain scales we have naturally are subjective. There's no objective way to measure pain between myself and Brian. Brian has a high tolerance for pain. I have a very low tolerance for pain, maybe, or maybe it's the other way around. But it was interesting because Vertex sold off because it performed very well. The efficacy was surprisingly high, but you know what? It was extremely close to the efficacy of the placebo. And the placebo effect is, especially with pain like depression, that's where it can really where a placebo can shine the most, is in a subjective interpretation of success or failure. So that seems particularly hard, but nonetheless, the drug got approved, and
so
the stock price recovered.
Just to be clear, it got approved in acute as an acute treatment.
Acute treatment. That's correct.
And the clinical trial you're talking about was in patients who've had long-term pain issues. And
it was a more targeted trial, the one that caused the stock to.
Right, exactly. It was in it was in patients that had pain for a long time, and so the difference maybe is the placebo effect is bigger in a clinical trial where the patients have had an effect for a long time. And this was a phase 2 clinical trial, so they weren't trying to get it approved for long-term pain issues with this clinical trial, but they were trying to use the placebo as a guide to try to figure out, basically like, how big of a clinical trial do we need to run to be able to separate the placebo from the patients that got the drug. Because I don't think anybody thinks the drug doesn't work. It's just that the placebo was so high that, there's no reason to think that these patients would stop having pain. It's not like acute pain where, so you go into surgery and you got placebo, you're eventually going to stop having pain, because eventually you're just going to not, you're not going to feel, you're not going to feel bad anymore. Where, if you have substantial, if you've had pain for the last year or 2 or 3, you're not going to just like suddenly stop being in pain without taking a new medication. So obviously this is a big placebo effect. And the question was, how big is they were doing the clinical trial to figure out how big is this placebo effect. And the answer was, it's really big, which is going to make it really hard for them to run a clinical trial that shows a difference between the drug and placebo. Some ways you can get around that is you put everybody on the drug. So everybody thinks you tell everybody that they're on the drug. You say everybody's on the drug, you're going to feel better. And everybody who feels better, you continue on. If you don't feel better, you exit the study. So everybody who feels better on the drug, and then you take 50% of those people and you switch 50% back to placebo, and you keep 50% on the drug itself. And now it's sort of tricking the brain, because you're on and then you're and then now you're off or you're not off, and for whatever reason that going that direction, makes it more likely that when the people who lose their drug, they know it, where the people who, don't, and the people who don't lose their drug, I feel the same as I did before, and so then you can measure the pain that way. So that may be and end up how they end up running the clinical trial.
So Brian, hold that thought till tomorrow, because you and I happen to be on together again tomorrow. And this is something that investors can learn over time. Drug design trial strategy. How are you designing your trials? And then commercialization intent. Like, how do you intend to use it? Sometimes that shifts as a drug goes through testing. These are some of the nuances I'd love to understand more. So let's have some more of this conversation tomorrow on those two topics. I'll remember it. We're here with less than a minute to go. We're going to break soon for the YouTube stream. And I just wanted to quickly say we had a question that was up from Besties on holdings, Deckers Outdoor, Nike, and Lululemon, which we have the highest expectations for the next 5 years. So I don't have really time to wend our way through those tickers right now, Besties, but I will say that for each of those, and on the Stock Advisor team, 3 of those are on our scorecard. We think a lot about all 4 of these companies. It's just important to see where they are in their particular cycle, how exposed they might be to, say, recession risk, which seems a little higher than it was before, and how they're positioned for the long term in their industry. Are they in turnaround, Nike, for example? Are they in strong growth mode, like on holdings? Are they somewhere in between, Deckers, Lululemon? But it's a good question as we think about some consumer names that might be under pressure in the coming quarters, but still seem like pretty good buys vis-a-vis tech names where you're gambling a little bit on the eventual trajectory because technology changes so much. So with that, we are at the 4 o'clock hour. So I think we'll pass this over to the YouTube stream. I will be back after a break with Tim, and we're going to be covering some earnings. But Brian, this is a pleasure, and we'll pick it back up tomorrow, as I said.
Yeah, and I'll be on for 2 more hours after you do earnings in the next hour. I'll be on for the 2 hours after that. So any healthcare companies that we missed, those will still be on the Q&A, and I'll grab them then.
Perfect. All right. Thanks a lot.